Good evening, friends. Today we have a very nice session on Ind AS issues concerning Ind AS by very learned faculty. But before we start with the session, may I request all to remember the ICI motto? Let us say the ICI motto.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता.
Yes, so friends, as we know, Ind AS came into being in 2016 for a lot of Indian companies, a listed one especially, and it changed the way we looked at accounting for various aspects, and it changed the way our profits looked or the assets looked, or how we accounted for various assets or liabilities. And over time, newer and newer standards have kept on coming into being. And there have been several questions which have kept on cropping up for professionals. And of course, the ICAI has kept on also coming up with guidance on the various issues which have come up under the various standards. So to take this situation further, in fact, we have with us a very expert, panelist. We have Sandeep Shah. Sandeep Shah. With his expert knowledge, he will be able to guide us on several of these Ind ASs. Oh, and we have several other panels also over the 2 days series that we are going to run. We will have most of the Ind ASs and the issues, live issues, which will be covered up. And with this, may I request our chairman WRC to share his vision and his opening remarks for the session.
Thank you, Rusli Madam. Thank you. First of all, very timely, and this is the need of the hour to have the program on Ind AS, because we are going to close the books of account in next week. So this is and very timely. It has been a structure covering all the important Ind AS. And thanks the faculty Sandeep Bhai, Ashutosh Pednekar. I also recognize the presence of Ashutosh Pednekar sir on this today program. So thank you for that. So this year WIRC is following a theme of bold. B stand for breast the change. That is what I personally believe is the one thing which is constant in life is change, and accordingly the way we are doing practice also has changed. 1 year before, maybe on 25th March 2020, if we would have thought of having a webinar on a virtual mode, so nobody was ready to accept at that point of time. But now, after 1 year, we are saying that this has become a common feature, having a webinar or maybe having a virtual meeting with the company and doing an audit also virtually has become a common feature now. So accordingly, according to time, we have to change and we have to go for the value addition, what services, value added service we can give to the client instead of compliance based service. Next is, once you are ready to adopt the change, the next thing is to organize yourself, organize your skill set, your office, your infrastructure, your knowledge, various things you need to organize. And next is learning. At WIRC, we always believe in quality learning and giving the various kind of learning sessions to the members, and we keep on doing that. And after doing learning, the next thing is to deliver a best quality service to the client, so which is very, very important that all the members should follow that. At WIRC and at various branches, we have taken an initiative to have a vaccine to our CA members and their family members, to have that vaccine on priority basis. The numbers we are seeing, they are daily, it is increasing. So I recommend and I request all the members to take this benefit. And if you are eligible for vaccination, do it at the earliest. Apart from that, you have seen that more than 100 changes has come in direct taxes between bill and act. And to understand that changes and that nuances and what will be the impact, for that WIRC has arranged a webinar on this Saturday, that is on 27th March evening 6 o'clock. So this webinar is absolutely free, but you can register for the link in advance so that you will not be disappointed to attend that program, which will be Gautam Doshi is going to discuss that changes in detail, so you can register yourself. Apart from that, MCA has issued few notifications yesterday evening. Various disclosure requirement has also come out, and again one other notification in respect of changes in accounting software, that is audit trail has to be there. So all these things also, we are organizing a program in first week of April, and we will soon announce the detailed webinar of on that program also. So those members who are interested can join that program. So thank you very much. Dosti Madam, over to you.
Thank you, Manish Bhai, for sharing your thoughts and insight for the year. Now, may I request my regional council colleague, CA Shushruth Chitle, to introduce the learned faculty for the session.
Thanks, Rushti. It's my pleasure to introduce CA Sandeep Shah. CA Sandeep Shah is a chartered accountant and managing partner of Ind AS Associates. He has over 35 years of experience in the fields of assurance as well as corporate services for various clients. He has been associated with the institute in several capacities, primarily as a member of the as a special invitee to the Accounting Standards Board and the Ind AS Implementation Committee. He has also been a Shield Panel member formed by the Research Committee for ICAI Awards, and he has also been a regular member of the panel for technical reviewers formed by the FRRB. He has also been a member of the PDC of WIRC and a member of the Accounting and Auditing and Corporate and Allied Laws Committee of the Bombay Chartered Accountants Society. He also serves on the executive boards of NPOs like National Burn Center, Somaya Education Trust, Rotary, etc. He's a voracious reader by nature, and his hobbies include gardening. But more than the formal introduction, I think at WIRC we would feel that we are truly blessed to have a speaker who exactly knows the subject, both in the theory as well as in practice. And I would say the same for, frankly, all the faculty. So over to you, sir. Thank you.
Can I have the slide, please, Om Prakash?
Sir, I'm waiting for the presenter. Yeah, I've been made the presenter. Just
Of course,
my screen is visible, sir?
Yeah. Okay. Thank you, Chairman. Thank you, Vice Chair, and thank you, Shushruth, for those kind words. And we have worked together as a team on various technical committees, and we exactly know that the entire emphasis is on uplifting and sharing the technical knowledge across the various sections of the professional brotherhood. And the beauty of each of the seminar is that you always keep on sharpening your pencil, because every time you put a word to your presentation, then you start seeing the difference between a comma and a full stop. that is the beauty of the seminar. And as Drushti had envisaged, that as the year is about to get closed, The question was that how can we take all the relevant accounting standards applicable to Ind AS framework between the four participants in a logical fashion and hopefully share the practical insights around what are the matters. Many of us would know, but it is always a good refresher session to have, because as we say that the final outcome is going to be relevant for the purposes of the reader's delight. In my opinion, a reader's delight is when you read something which is technically right, which makes a lot of meaningful sense, and you are able to appreciate the efforts of both the preparers and the auditors and everybody involved in the transaction. So there are 6 accounting standards which have been allotted. I have an hour and 20 minutes, and in that hour and 20 minutes, I have 10 minutes for the question answers from Drishti Madam. And we have my next speaker, CS Sumit Seth, an extremely knowledgeable and profound professional veteran, and therefore I will not want to even eat even 1 minute into his timeline. I may have to rush through some of the slides considering that there is so much to share, but this information will be available and will be circulated by the WRC. So without investing any further time, can I look at the... So the theme is very clear. What is inside is reflected outside too. Lot of efforts is made by everybody, and the question is that if there is any lapse in what the final product is, then how much ever efforts you have done in creating that product is not given credit for, because what the readers are going to read is what is in front of their eyes, and therefore with this the theme or the thesis in mind, we're quickly trying to see that what does each of the standard require us to do. We have essentially covered items from the the knowledge which has been gathered over the years in terms of the excellence awards. The FRRB recently came out with the publication. Then we have from the IFRS, we have some of the tentative agenda decisions for which are either finalized or which are under consideration and which are contemporary topics. So between these 3 or 4 is the methodology which each of the speakers in this 4 session is going to take it on. So I begin with my first part of the standard, which is on 115, revenue from customers. And here, as the year is coming about to a close, and this is a reality of challenge everybody will face, that the goods are sold to customer on ex-factory terms, but the goods are not physically dispatched. Now we all know that everything is becoming just in time. The COVID has got various different formats, and the question is that you have not dispatched, you are waiting for the instructions to deliver the goods. And now the question is that whether is control transferred, not transferred, whether is the revenue to be postponed, what is required in a similar situation. And here is the case where FRRB also had a similar situation, what they call is the bill and hold arrangement. And the question finally is that unless the entity is able to establish that it has substantially completed its performance obligation, the revenue recognition need not be, or rather, if it is substantially completed, then you need not postpone the revenue. And therefore, the documentary evidence to suggest that the goods are held at the behest of the customer on a contemporary time basis is going to be fundamental for compliance with this one part. And in specific, we refer to paragraph B79 and B82 of the Ind AS 115. We are trying to bring in as many relevant paragraphs so that the readers or the participants here are able to go back and look at the relevant paragraphs. So So this is one area for compliance as the year is about to end. Going forward, we have the a similar situation also we would have experienced. We also have been beneficiaries during the COVID, or we have actually given away extended service because the physical offices were closed for substantial period of time. So the question here is flowing is that the entity has sold a product with a standard warranty of 2 years where defective parts will be replaced. In addition, it has also provides additional warranty of 2 years on payment of additional consideration. That's the commercial arrangement which has been entered into. The entity records entire amount as revenue from sale of products including extended warranty. Warranty related expenses are accounted as and when they are incurred. Now, assuming that if you had any accounting policy on this fact pattern with this treatment, obviously you have paragraph B28 and B33 which talks which deals with it very differently. So the first part, which is your standard warranty, obviously the standard requires that you need to establish whether the warranty given is assurance type warranty or service type warranty. That's a starting breakdown. In this given fact pattern, the standard warranty is in the nature of assurance type warranty, and therefore the sale of product along with standard warranty will be a single performance obligation. Provision for expected warranty cost will be made in accordance with Ind AS 37 because that's what deals with the cases where revenue is recognized and you have a standard type warranty or an assurance type, and therefore you have a provision. But when it comes to the extended warranty, which is bought separately, maybe dealt with as a composite consideration, but the fact is that the customer had a choice whether to only take standard or to take extended, and therefore additional warranty would be in nature of a service type and will be a separate performance obligation and will have to be dealt as a separate revenue over the tenure and not upfront. So what we have in front of us is para B28 and B33, and therefore all those who are goods and service or in service we have an extended. This is one part of the care which will have to be taken as the year ends. Going forward, we have a situation where schedule for revenue does not separate revenue from sale of products and sale of services. We saw in the earlier question that you had a sale of capital goods along with the extended warranty dealt with in a singular price. And the question is that whether is the would the company or entity be justified in aggregating both the sale of goods and extended warranty under a singular disclosure as sale of goods. So the question here is that sale of separate performance obligation of sale of product and performance obligation of extended warranty is clubbed and disclosed as a sale of product. Assuming this was the situation, obviously you have that there is a separate disclosure required for revenue earned from sale of product, sale of services and other operating revenues. And we also have our Schedule 3 Division 2, specifically serial number 3 on the general instructions which will give this. So we will not be able to combine both the aspects together, and care should be taken that what is to be reflected as revenues from the sale of service is not clubbed with products or vice versa. Many industries have a thin line, and therefore when a judgmental call is being taken, the required disclosure will help, because what happens is that every reported balance sheet is reviewed also from how your MDA section is giving the information. So your disclosure in the notes vis-a-vis how your MDA section is disclosing the information, both of them will have to be tagged together, and these are some of the real-time non-compliances is what we have also seen during the review during the excellence process. Going forward, the next question is about the disclosure made for warranties and related obligation. And the reason why we are taking all connected items is basically to say you have recognition, measurement, and disclosure, and you have disclosure under the accounting standard, and you have a disclosure under the Schedule 3, and you may have disclosure under the specified mandated disclosure by the regulators. So if one has to look at each one of them, one will have to be mindful of the requirements under each of the buckets. And here is the question that the disclosure in regard to type of warranties and related obligation is mandated under para 119E of Ind AS 115. So that would be another set of disclosure which has to be taken into consideration going forward. So we have a situation that you had an extended warranty and other adjustments not disclosed in the reconciliation with contract revenue. And as we would see that the 115 also has a disclosure as to how between the contracted revenue versus what has been disclosed as a revenue under the audited statement, how does the reconciliation happen? And therefore, attention is given to paragraph 126AA of 115, which expects the reconciliation between revenue recognized in showing separately each of the adjustments made to the contract price for the discounts or rebates or refunds or service level credits, and just to put this point as to how some of the disclosures are necessary, we would see that you have the in terms of the changes in contract assets which begins from the beginning of the year, recognized during the year, invoices raised during the year, you may have translation differences, and then you have the balance at the end of the year, that as far as the contract assets are concerned. And then you have unearned revenue or deferred revenue, and your warranty will fall into this categorization. So what was the revenue recognized out of the opening unearned revenue? What is the increase due to invoicing during the year other than what fell during the 12-month period? And then what are the translation differences and what goes at the end of the year? And then you have similarly on the contracted price, which is what was your contract value, what was the reductions which you gave, and here they are not expecting you to give individual component, but if there is something significantly, if you have taken some aspect on your liquidated damages, or you have taken performance bonuses, and if you think that those are important numbers to highlight for the readers to understand, then you would give this as an additional line item, and then what is the revenue which is recognized. So these are some of the matters in relation to the the reconciliation which paragraph 115 requires you to give. Going forward, here is the situation where you have AMC services to customers, and the contract is usually for 3-4 years. In respect of a contract with a customer where contract period was from, let's say, 17-18 to 2021, and due to ongoing COVID pandemic, and we are still experiencing even at this particular point of time that while significant amount of things may have seemed to be normalized, but we still have the challenges around pandemic, and so therefore due to ongoing COVID-19 pandemic, the contract is modified at the commencement of financial year 2021 by way of reduction in consideration, because maybe the underlying equipments were not fully utilized. Maybe in some cases, if it was a CMC, maybe there can be a situation that because of afflux of time, the risk remains and there may be a very limited reduction. But in case of an AMC, because it's a pure service and parts are extra, maybe some modifications have happened, whatever may be the combination. So here is a case where it was by way of reduction in consideration and also extended for another term of 4 years with reduced consideration. Now this could have been the combination in which the service provider and the entity agreed upon the services, and the question was that whether is the entity required to evaluate the impact due to modification of the contract or not. As we know, paragraph 18 to 21 specifically deals with the modification. And here also, this was one of the cases which came up in the FRRB observation that the entity should evaluate whether the modification results in a separate contract or not and account for revenue based upon the aforesaid evaluation. If we look at the, just to give a perspective to what is that practical question which we are talking about. So XYZ provides AMC services to its customers for the air conditioner sold by the original equipment manufacturer. XYZ has entered into a 4-year contract with a company PQR for 4 lakhs. So let's say 1 lakh per annum. And at the beginning of the 4th year, we saw 2021, both parties agreed to modify the contract. The service for the 4th year is reduced by 20,000 rupees and the existing contract is extended for another period of 4 years for 3 lakhs, because finally we have reality seen that everybody has negotiated for a reduction, whether it is either it is an AMC, whether they were the landlords under the rental arrangement where you had to give credits for the rent to the tenant or the lessee, and everybody wanted to secure the future period where you did not want to say that you give a credit and then the tenant terminates the contract at the end of the scheduled period where you have actually lost out on the discount and you've still not secured the tenant for the balance period. So we have seen in mall scenarios, we have seen in AMCs, in various industries, we have seen this kind of that on the extension also below market price arrangements were made. And now the question is that if you had to determine the accounting for contract modification will be carried out as if it was a separate contract, let us see what would be the answer be like. So what will be the amount of revenue which will be accounted in the 4th year in the statement of profit and loss account? Unfortunately, if this was a classroom session, I would have probably asked the audience to give me an answer, but in the webinar, because I'm not able to answer, so you have 2 questions in front of you, whether is it 80 or whether it is 76,000, and the response will be 76,000 because you have to factor also the future negotiations which have happened and the period which has gone beyond the 4th year. So that would be the answer as far as the modification in the 4th year is concerned. Going forward, this was the situation where while selling the product, the entity gives an unconditional right of returns to its customers, that they can return the product if they are found to be defective at the time of receipt. And based on past experience, the entity makes provision for margin in respect of products expected to be returned. And we now know that the online sales has gained traction to the highest. Apart from that, various other offline stores are also giving the similar services. And the question was that if this was the policy, that if the entity was only making the margin, whether under the Ind AS framework, whether this is in compliance with the Ind AS 115 or not. And here we look at the paragraph B20 and B27. So the practice of margin, which was also a part of the original ESC opinion, would have been all right under the IGAP, because under IGAP we did not have the right to return as a concept. So all that it said was that you had a choice of either reversing the entire sales or you had a choice of taking the margin as a part of your liability. That was under the Indian GAAP, but under the Ind AS, the sales amount needs to be adjusted with the sales amount of expected returns with a corresponding credit to refund liability, and the cost of goods sold will obviously be an inventory which will happen. So this is one area where we have even in as recent as March 20, we have seen that some of the accounting policy on refund liabilities did have the IGAP treatment. Going forward, so here would be a situation that you have specialized spare of machinery, terms and conditions are manufacturing defect, and you sell at the standard price with the margin is 2,000 rupees. You expect to receive back in next year 5% of the units sold during the year. Hopefully, every manufacturer wishes that there are no returns which happens, and but the reality zero defect is also a wish of every company. But in reality, we see that the returns does happen on account of the manufacturing defect, maybe during the course of transit, maybe during the course of the manufacturing, which may not be picked up during the course of the quality control. And if you have sold 1,000 units, the reader and whatever returned products which will be sold as a scrap. Now there may be in some cases you give the power to the buyer to dispose it off because the cost of return is significantly higher. In some cases, because the manufacturer wants to control and identify the batch numbers in which this your returns are happening, so that they can take corrective actions before there are any significant both the reputation loss and material loss. So there may be a cases where while the scrap may be 100, but your cost of recall and bringing back to the factory may be sometimes extremely high. But that's the call which the company will take. And if we are about to close the year, these are classical examples of work which has to be carried out, so the compliance happens. And let us say that 1,000 units, 100 rupees scrap, 5% return, and the question is that how much revenue will you recognize? So if you had 50 lakhs of revenue, 5% is 47.5, and then you will have the value of the material, which obviously will be at scrap, and in some cases the cost of bringing back may be even higher. So your question therefore would be that you only get 100 rupees, and there may be even a significant cost of bringing it back, for which you may have a further liability. But that would be again on facts of each of the cases which will have to be analyzed. Going forward, again on 115, this is again one of the question which is the FRRB observation was there, that whether the disclosure, so this was a case where they felt on the review, on examination, that the disclosure was not made for significant judgments applied in application of 115. And as we know that 115 has got 5 steps, it has got lot of judgmental aspect, both in terms of whether is there a variable consideration, whether there is a constraint in variable consideration or not, whether there is a likelihood of non-realization of the sale consideration, whether is it at a point of time, whether is it at a over a time. So there are significant judgments which are required before revenue under 115 is recognized, and we specifically look at para 123, where what would be a typical disclosure in accounting policy, which would be which would have to be factored in, and it will have contract with the customers and significant judgment in applying the standard, which is the company's contract with customers mainly include promises to transfer products and services to a customer. The company assesses the product services promised in a contract and identifies distinct performance obligation in the contract, if any, and therefore it is important that whether is there a different performance obligation or not. That's also a case of a judgment. Then you have the judgment is required to determine the transaction price for the contract, because as we see that in some cases you have standalone prices for each component, but put together you have negotiated a single price, and the question is that in what weightage will the standalone prices will get allocated, which we also call about multiple deliverable contracts. The transaction could therefore be either a fixed amount of consideration or a variable consideration with elements such as volume discounts and incentives. So whether am I going to be eligible for what incentive, what is the constraint which are going to follow. So the estimated amount of variable consideration is adjusted in the transaction price only to the extent that it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not occur and is reassessed at the end of each reporting period. And therefore, even in the current scenario of COVID pandemic, where there may be a situation where you may have an incentive or you may have a penalty to pay, and all of a sudden you may have a lockdown which may get announced, and throughout the 2021 there has been an argument and lot of legal matters have reviewed the commercial contract, that whether is it a force majeure or is it a failure of a contract, and therefore the question of this judgment will be that if under a contract there is a further deliveries to be made, the question would be that how much judgmental call will be made by the companies in relation to COVID as per the current scenario and the likelihood of there being a lockdown which may result into failure to deliver in time, and whether those will be a penalty or it will be treated as a force majeure. So these are various aspects which have to be dealt with, and there would be disclosure specifically around COVID-19 if whatever the judgmental inputs have gone into determination of the transaction price. So very important role. Going forward, there was also a question around the inadequate disclosure in regard to disaggregation of revenue. Now, this was also another matter which came up, that how do you break down the revenues and what is a disclosure which are required for the purposes of a reader to understand. And therefore you have the nature and amount which can be in terms of what was under a point of time, what was over a period of time. So what was the nature, amount, the timing and uncertainty revolving around this revenue, and the economic factors affecting the cash flows, because each of these are important tools for the purposes of both the investors, the analytics, the academicians. Everybody is looking at the composition of the revenue because they are looking at also prediction in terms of how the companies are going to behave going forward, and therefore para 114 of Ind AS 115 deals with this aspect very clearly. Let's quickly look at what are the disaggregations again, by nature of services, which is what is by way of a consultancy, what is by way of a sale of equipment and software licenses, how the disaggregation has happened by the industry verticals and by geography. So these are, while somebody may come back and say that some of this may be part of the operating segments, it may not be, but the question is that specific requirement is of this para 114 in terms of the dimensions. When you actually slice the apple, they give you the different elements of one revenue, but which has got multiple parameters, and each of them have a very judgmental call. In some cases the geography may be to do with the exchange component, in some cases it may be to do with GDP growth, in some cases it may be to by the industry verticals, it may be by saying that okay, which industry is likely to grow better than the others. There may be situation around the RBI packages for those industries. So there are multiple dimensions to this, and again an important piece of disclosure. Going forward, this was a case again where the entity is selling the products with different credit terms, which includes credit term beyond a 1 year period. So we are saying that it's reasonably, one estimates that if it is less than 1 year, whether do I need to adjust my contract price or do I not need to adjust my contract price. But the accounting policy, even where the credit terms were given beyond 1 year, the accounting policy states that no element of financing is deemed present as the sales are made with a credit term which is consistent with the market practice. And here we may want to refer to para 6065 in specific. So what it states that for determining the transaction price, an entity is required to adjust the promised amount of consideration for the effects of the time value of money if the timing of payments agreed to by the parties to the contract, either explicitly or which is implicitly, provides the customer or the entity with a significant benefit of financing the transfer of goods or services to customer. Here, the requirement therefore is existence of element of financing is determined as per 115 and not by comparing the market practices. And therefore, in this particular scenario, because the credit is beyond period of 12 months, the element of financing will kick in, and therefore one will have to adjust it. So here is a case where we are, quickly just to bring perspective to the point, you are selling a machinery, credit periods are on delivery is 4 lakhs, 2 years is 5 lakhs. And the question is that whether this 1 lakh maybe in terms of the market price, because you may have a lot of equipment suppliers which may be giving short-term credit across the market. But the question is that whether on this fact pattern will you recognize 4 or 5 lakhs? And considering para 60 to 65, you would definitely have 4 lakhs, and the unwinding of 1 lakh will happen over the rest of the 2 years. Would be the correct application of para 60 to 65. Going forward, quickly we have this is a kind of a very tricky situation that you have an entity which is in power distribution, and which was one of the matters which was before the FRRB. The entity with accounted, and as we know that you cannot hold power. I mean, like it is not a storable commodity, and the question on the fact pattern was that it accounted for contribution received from consumers towards the service lines as capital reserve under other equity. Now this was one question, and I have a limit, and I have a connected question again in the second part. But the first part here in a power distribution, that you received from the consumers the credit for the contribution for service lines, and that was credited under other equity. And the view was based on an expert opinion received that said that the capital contributions are not refundable to the consumers even after they cease to be consumers, and therefore the underlying assets will continue to remain again with the entity. And the question is whether this contribution needs the treatment under other equity is correct or not. And we look at paragraph 15 of 115 specifically, that when a contract with a customer does not meet the criteria for determining in accordance with para 9 of 115, and the entity receives consideration from the customer, the entity is required to recognize the consideration received as a revenue only when either of the following events have occurred. You have no further remaining obligation, substantially entire consideration is received and the amounts remain non-refundable, or contract is terminated and consideration received is non-refundable. The contribution received from the consumers should be recognized as a revenue and not as a capital reserve or other equity, and therefore treatment to other equity was not right, and therefore it is important because this applies in many industries where there is a non-refundable contribution. This is even in terms of the pipeline gas, this happens in electricity, and there are various other industries to which this applies. Going forward, the question was the revenue, which is in this particular case, the interest income is accrued in current year as well as in the previous year. That was a question. And the entire receivable is written off in the current year as no longer receivable. And the question was that whether the recognition of interest income in year 1 and year 2, what else was required to be reviewed before, whether subsequent write-off by itself means that whether the revenue in the first instance was incorrectly recognized. Obviously not, but the criteria for 115 for determination of a contract with a customer is to establish the probability that the entity will be able to collect the consideration to which it is entitled, and the measurement principle is guided by 109 because there, in this case, there is a measurement and there is recognition, and therefore, if the recoverability of interest income was not certain, the recognition of the same should not have been done, and so therefore the strict compliance with para 9E and para 5.1 of 109 would have to be reviewed for the purposes of complete compliance with the standard before this interest income is recognized. Going forward, as I was mentioning, that the entity is in the business of power generation and distribution, and while preparing profit loss account, and also a situation if you had a trader in between, and as we know that the CERC, the Central Electricity Regulator Commission, has time and again intervened as to how much margin, maximum margin, a trader can retain. Currently, as far as the, I think the 2020 or little earlier, CERC has given the maximum 7 paisa per unit. And the question which we are looking for is that if you are a trader, there is a generator, there is a buyer, you are a trader, and the question is that whether the revenue which is from a buy and sale, as we know that you can't physically control the electricity, and it has either, if the receiving stations are not there, then the generator will have to reduce the power, and in that window it will go to the unscheduled category, and the SLDC, the scheduled load and delivery center, will give you some credit for a reduced generation. But the question in front of us is that whether have I bought from generator and have I sold gross, or am I an agent? And the question very clearly, which is there in front of the companies to analyze, that whether am I in my capacity as a agent or as a principal. And we have para B 36, 37. There may be an element that whether can you be said to be controlling the product. Probably answer is no, because you can't actually come and store, but there are multiple parameters. So whether am I controlling, whether do I have an inventory risk before or after. Now the question is that the inventory is a pass through because you can't physically control. Do you have a discretion in establishing the prices for the other parties' goods and services? Now here sometimes your CERC comes into play. And then finally the question is that whether are you receiving this in form of a commission, and whether there is a credit risk for the amount receivable from a customer. Now there are various variants in this part of the industry. In some cases there may be an you are the trader may be pure agent. In some cases there may be an arbitrage where you buy from the generator and you sell to the discom, and you may be taking a counterparty risk. So the question which is there is that whether could it have been netted off, or it could have been shown as gross. Nonetheless, the paragraph B 36 and 115 and guidance note on division 2, this is one industry where lot of minute deliberations and contracts and commercial arrangements have to be made, and this is one industry where one can not unless the disclosures are correctly made and they're correctly analyzed with the commercial contract, there can be a challenge. If you show gross, you have a challenge. If you net it off, you have a challenge. So I would recommend that this is one industry where a lot of attention should be paid for the nature of commercial contracts and how this is going to get disclosed, whether as a principal to principal or agency relationship, and whether the compliance with paragraph 36 and 37 is happening or not, and what disclosure one is making, both in terms of the accounting policy, in terms of the risk and into the risk management practices which one gives under the MDA section, and therefore everything will have to fall in place for the purposes of whether it is gross or whether it is net. Going forward, we felt that along with the vice chair, we had discussed that if there are any tentative agenda decisions which IASB has reviewed during 2021, which either have got finalized or which are matter of considerations and which will be taken up by the committee as finalized, maybe it will go up to the committee for final adoption in the subsequent year. And this was a situation. Our IPL has been a format, Kabaddi has been a format, and India has also experienced today that there are the formats in which there are BCCI may be selling the contracts, or maybe others may be giving the contracts to the participants. And the question which was there before IASB, the FRIC on a tentative agenda commission, was to deal with IFRS 15 and IAS 38, which was, and what I would like to quickly highlight are the fact that there was a situation where there was a player transfer payments, and the question was that whether do you recognize the consideration which you receive minus the cost which you may have paid under IFRS 15, or do you show it as a gain or loss arising from derecognition of the intangible asset applying IAS 38? Because for the companies who are participants in this game, while what they have paid may have got classified under 38, but it's a routine transfer of contracts, and there are large arrangements which are made because not everybody can hold the player for all long duration. And the committee was received a request that the recognition of player transfer received, whether would they be justified under 115, and the entity was saying that I transferred a player to another club. When the entity recruited the player in the inception, it obviously registered the player in an electronic transfer form. The registration means that the player is prohibited from playing for another club. So therefore, the condition of control under IAS 38 was satisfied, and there is an employment contract, and you are leaving the club without mutual agreement. So until you say yes, the player cannot transfer, and therefore this was what we called the registration right, and the cost which the entity incurred at the inception was classified as an intangible asset, and as a part of its ordinary activity, the entity uses and develops a player through participation in matches and then potentially transfers the player to another club. So that's a systematic activity, and the entity and the receiving clubs thereafter enter into a transfer agreement under which the entity receives the transfer payment from the receiving club, which is the new entity which takes over the player, and the transfer payment compensates the entity for releasing the player from the employment contract before contract ends, and the registration is done. And the question is that what is perceived to be in regular course of its business, that you will acquire players, you will use them for the matches, and then you will transfer to them before the contract period. And the question which the TED answered is that the the final answer is that the recognition will be a derecognition of IAS 38 will have to be reported as gain or loss on derecognition and not under the IFRS 15. And they have therefore applied the para 113, and so this is going to be, you know, an important. The objective of bringing this is that these are what we call our contemporary issues, and when they are contemporary issues, it is important that, you know, such kind of issues are manifested under different industries, and therefore the correct application and assuming that there was any confusion around, then whether is there a need that if there was none of the standards were dealing with this matter, then whether under Ind AS 8 whether the companies are required to formulate an accounting policy so that the readers understand that how the treatment is happening to something which is not squarely falling under any of the standards. Going forward, so just one slide back, and therefore you know, the on 113, as I mentioned, that this cannot be revenue, it will have to be dealt with derecognition, and we have provided for the source or reference. This was in June 2020. Going forward, so we have a situation of Ind AS 36, so that deals with my 115 is what the first part of the section is over. Now we look at the impairment of assets, and here the question was the recoverable amount is calculated to determine amount of impairment loss to be recognized. However, disclosures for discount rate applied for cash flow projection used for arriving recoverable amount is not given. So as we know that para 130 and 134 of Ind AS 36 deals with the specific requirement as to how recoverable amount is calculated. It also includes disclosure for discount rate, and as we know that we have to, the entity is required to use the pre-tax discount rate and not post-tax, because that's another area where we have seen a lot of non-compliance is happening. And one has to also see that whether if there were any changes between the current and previous years in the measurement mechanism, then also a complete disclosure will have to be made. So we have found that in many areas attention is not paid to the paragraph 130 or 134, and in some cases whether it is pre-tax or post-tax, that is silent. In some cases the post-tax is being used, and some may argue that, look, if I have taken post-tax cash flows, then my post-tax rate also is available, but which is currently not the requirement of the standard. This issue is there before IASB, that whether in reality whether pre-tax and post-tax under both the scenarios will have a mirror image or will not have a mirror image, and the IASB still is not fully convinced. There is a discussion paper, but as the situation stands today, one will have to use pre-tax discount rate. If I was to look at further down on the additional disclosure for the intangible assets with indefinite useful life, and whether the company has considered cash flow projections for 10 years for calculating value in use, and the justification for considering such a longer period is not given. And as we know that paragraph 33B read with para 134 and 137, it has a specific requirement on additional disclosure, that what is the basis of determination of the recoverable amount, which is the value in use or fair value less cost of disposal. And if it is determined with reference to value in use, then each key assumption on which management has based its cash flow projections for the period covered by the most recent budget or forecast, descriptions of the management's approach to determining the value assigned to each key assumption, the period over which management has projected the cash flows, and when one uses a period greater than 5 years, and then an explanation as to why longer period is justified. And all those may remember that even under the earlier IGAP, or rather under the IGAP, we used to have that if there was a kind of a 10-year, a benchmark, but if you amortize it greater than 10 years, you still had to give your justification. But here also there is a specific requirement that if you use greater than 5 years, then why that period is justified, because as everybody believes that longer the period in future, the greater the uncertainty and the greater the variability, and therefore more reason why the companies believe that those cash flows are more relevant and a longer period is more justifiable. What is the growth rate which is used and what are the discount rates applied? And in today's scenario where growth rate and discount rate and the larger challenges with the various kind of quick changes which pandemic has brought about, each of this has its own relevance even while the year March 21 is about to close. Going forward, we have on intangible assets a situation where the website was developed by the in-house team and the costs are incurred were eligible to be capitalized in intangible assets, but no disclosure was made in the financial statements that it is internally generated. And we presume that this website are a part of an operating mechanism, because it is used as a tool for receiving the customer orders and dispatch and whatever. And the internally generated, and as we know that para 118 deals with specifically deals with if it is in-house, then an internally generated intangible asset should be separately disclosed along with its useful life, amortization method, gross carrying value, accumulated amortization amount, and the balance period. So these are because one cannot add internally generated goodwill with the acquired intangible. So lot of cases we find that there is an inconsistency around this compliance with internally generated, or even if it is purely acquired, we find that many companies are not mentioning that this is other than internally generated, because as I was mentioning, that reader, you cannot leave the reader to a judgment to say that whether was it acquired or was it internally generated. And therefore a specific requirement will have to be also said that if it was nothing is internally generated, then one must say that what is acquired is other than internally generated, and therefore all these paragraph references will not kick in. We also have similarly a situation where an expenditure of, let's say, 1 crore of rupees was incurred by the entity for development of an eligible intangible assets. This expense is comprised of staff cost of 60 lakhs, consultancy fee of 40 lakhs. While preparing the financial statements, total amount of 1 crore was disclosed as intangible assets under development, and details of broad nature of expenses capitalized along with amounts is not disclosed. As we know that the disclosure of broad nature of expenses is required to be given along with the amount capitalized, so one also knows what is the broad component of such cost and not one singular figure. Going forward, if the entity was in the business of manufacturing of products, there was a dedicated R&D department for the purposes of adding new products to its existing portfolio. So during the year, R&D team had incurred expenses towards research phase and development phase of few products. Entire amount incurred is capitalized as an intangible asset, and many a times, as I had in my tagline said, what is inside is outside. So in reality, if you had not capitalized the research, but assuming that through innocuous error, this word slipped in, as we know that the Ind AS 38 specifically, which is para 54 and 57, explicitly requires expenditure on research phase to be recognized as an expense immediately. Further, any expenditure on development should be recognized as intangible if the recognition criteria otherwise are met. So many a times this the research and development word goes together, but but the treatment under the Ind AS 38 is different, and therefore it is important that very important attention is paid to the accounting policy and the choice, and including the notes that under no circumstances what was supposed to be put to revenue and which has actually been put to revenue correctly, but because of choice of words, it appeared that you have also capitalized the research phase. So that's para 54 and 57 for you. And again, like we saw one under the 115, there is also a tentative agenda decision under the Intangible Asset 38, and this is something which is a matter of a big contemporary issues across the world, that over the years we have seen that service as a arrangement, SaaS model, as the software as a service arrangement, the SaaS model, as we know, is gaining traction across the world and in India. And we also know that there are customers who are supposed to be incurring specific cost for the software which is deployed by the supplier, and the question which is coming up, that configuration for that contract to kick off is something which is runs into significant amount of money. And the question which was raised before the IFRIC and which was considered by the committee as to what is the treatment of such cost which I as a customer have incurred or reimbursed to the supplier of services for the application software which will be deployed for providing the entity services, right? So I am the customer. I have incurred cost for the supplier's application software because it has to be customized to my need. It will be provided to me as by way of a SaaS model. And the question is, I have incurred a substantial cost at the inception, and the question is whether can I be treating this as prepaid cost? Can I be saying that I will treat it as a intangible asset? Can I amortize this cost over a period of service? Now, as we know that the arguments which are there before the IASB and which continues to be made is that in the rapid development of the digitalization world in last 2 years, everybody is finding difficulty that whether Prakash, little earlier slide please. Everybody is finding it difficult to say that whether can I be said to have control of a particular code in that application software. Maybe nobody else is entitled to receive that benefit of the cost which has got customized. But the question which is there on the fact pattern is that whether can I be said to be controlling? So that is one analysis which has to be done. The question is that while you may receive the benefit of this cost over the tenure of the service provided by the supplier, but the question is that what is the point of time when the supplier is deemed to have completed its part of performance obligation, and if that part of the performance obligation is completed and you are not controlling that code, then comes a question that whether is that outright cost, because you have to apply the paragraph 38 in terms of whether the intangible asset is deemed to be controlled or not controlled, right? So the question which was there in front of the tag was that whether one earlier, whether the configuration involves setting up of the various flags or switches from the application software, and it also involved modifying the software code in application or writing additional cost, and there were obviously the customization, and therefore the question which the tag considered were two questions. Next. So in analyzing the request, the committee considered whether applying IAS 38, the customer recognizes an intangible asset in relation to configuration or customization of the application software, which is question 1. And if the intangible asset is not recognized, how does the customer account for the configuration or customization cost, which was the question 2. And as I mentioned, that these are going to be now whether they've also deliberated that whether while looking at the treatment, while Ind AS 115 deals with from a revenue recognition from a supplier side. The question is that whether I, as a customer who has paid for that cost, whether do I look at the Ind AS 115 while determining my treatment of such cost incurred and the period over which I will incur, or do I need to develop a new accounting policy, because we feel that neither IAS 38 deals with it nor or IFRS 15 deals with it, and therefore one would like to have go to Ind AS 8, which also says that if nothing is covered, then you will develop your own policy as to how this has been treated. It's an extremely interesting matter before the TAD. They have while concluded, but under the due process, they will be taking up the final authorization in April 21. But I would believe that for many preparers and many auditors and team, this customization for receiving under the SaaS model is a burning issue for everyone, and it's interesting to review and pay consideration to the questions around this, because what you do not wish to have is that while TAD does from the Indian perspective, obviously while we don't have anything from the ASB which has come in this matter, but we should definitely, there is an evidentiary value and there is some persuasive value of the questions which are there. Going forward, I would like to quickly look at the one para 16, and I'm running little short of time, so I'm gonna quickly run through the 16. So here the question is that whether the considering higher useful life as compared to Schedule 2 was not given, and I would urge that one looks at the requirement of Schedule 2 specifically in terms of, even if it is technically assessed vis-a-vis what is the generally assumed useful life, one must pay attention to that disclosure. The second part was that if there was a self-constructed asset, if it was capitalized in August 20, which was substantially ready for its intended use, but you actually put it to use on 30th September, maybe because of COVID, it was available, but you did not put it to use. And the question in this was that you capitalized subsequent costs between August to September, either in terms of borrowing cost or whatever. And as we know, that paras 22 of 16 says that if it is already ready for its intended use, then all subsequent capitalization has to stop. So COVID or no COVID, one will have to look at para 22 clearly and apply 16 para 22 of 16 and 22 of 23 while dealing with the matters of a delayed put to use. Going forward, we have in terms of the accounting policy, if they are silent on review of residual value or depreciation method or useful life or component accounting, you please look at para 43, 47 and 51, and every year one will have to review this and also see that your accounting policy gives complete information on this compliance. Going forward, we have the category wise movement of fixed assets for previous year is not given, which is also equally applicable for CWIP. And now specifically you have paragraph 74B and you have division 2. Also there is a specific requirement of the movements to be given. It can't be just opening and closing even in CWIP. And going forward, yes. The fair value of invest. So coming, and as we know that the Currently, there are 2 amendments which were announced by the MCA yesterday, both for intangible and for the PPE, which were under development, where now the aging has to be given. So that's an additional requirement which one will have to actually go back and start determining as to what is the breakup. So there's going to be a lot of work for companies if you are about to close your financial statements in the next 15 days, because that announcement has just come in yesterday, and so one will have to factor the requirement for that disclosure as well. I have investment property where the fair value of the investment property was not given, and as we know that para 79E requires, because we do not have a fair value model under Ind AS 40, there's a carve out. So the entities are following a cost model, but one has to give the fair value, and if it is not practically possible, then you have to justify why and give an explanation as to why fair value cannot be measured. So that's as far as we find a lot of non-compliance around that. And also we find that many a times the depreciation on what is classified as an investment property is not given. We also know that even under the 1956, back in as late as in 57, there was a circular that even if you had classified as an investment property, you had to provide for depreciation for the assets. And here we have paragraph 5 and paragraph 30 of Ind AS 16, whose reference has to be drawn, that only because it is held for rental or for appreciation does not preclude the entity from not charging depreciation. Going forward, so these are, I was just mentioning that these are the 2 amendments which are there: the reconciliation of the gross and carrying amount of each class of assets at the beginning of the change in more than 10 due to revaluation, your investment property, then your PP has been revalued or not, and aging for CWIP as intangible assets under development in the prescribed format, and schedule of project whose completion is overdue or exceeded its cost compared to its original plan shall also be given in the prescribed format. This is going to be extremely time consuming for a lot of companies whose large greenfield or brownfield projects are under development. So this is we couldn't this panel of all 4 could not have been more contemporary and timely in terms of the intention. Going forward, this is one of the last of the point on 105, where the question is that the company had an wholly owned subsidiary. You had an agreement with the prospective buyer that during 2021 or 21-22, as whichever case you may be, you will be selling the shareholding, which will be subject to the NCLT approval, and there can also be a kind of regulatory approval. Maybe an RBI authorization was necessary. The sale of shares will be by way of a merger of the subsidiary with the company prospector, and the NCLT was approved before 31st March 21. If I was to juxtapose everything from 20 to 21 and assuming that I got approval of the regulator in March 21 and NCLT came in the subsequent period, and the question is that after the merger, the entity could not have held more than 10%. That was the regulator's requirement. And the question is that whether as of March 21, there is a committed sale, there is in principle approval of the regulator, the process of NCLT has begun, but your final endorsement will come in the next year. And the question is that whether this subsidiary should have been shown as a asset held for disposal or not, and if the fact pattern was that there was already a commitment, a regulatory approval for sale without which one could not have taken, if that has also been received, then certainly this would have become a part of an asset held for sale, and the disclosure would have to be done. Now there will be a situation whether I may be under control, but it is still an asset held for sale and by way of a discontinued operation. So if lot of attention should also be given to such matters which are under on the reporting date are under development, and the correct classifications will have to be provided for both these assets, whether they are under control or if in the intervening period, if there are sales, whether those sale is an equity transaction between the investors or between the shareholders, and only on derecognition or on the disposal of control, this will be treated as a sale proceeds. So we feel that we've seen some challenges around this treatment, and we urge that some attention be paid also to 105. It is not only about the fear only by way of plant and machinery, but it also applies to the subsidiaries. And as we know that subsidiaries which are under disposal, there are specific rules under 105. Yes. So as I mentioned that we have maybe 7-8 minutes before the next speaker comes in. Thank you so much for all the patient listening. Vice Chairperson, if you have some questions, please.
Sure, Sandeep. This was an excellent, insight into very critical issues which have been coming up. So, okay, so there are some questions here on the screen, but before that, may I just put up some additional questions which I have been posed with. So, one is that how is this revenue recognition done in case of real estate companies? And how does one determine the same when it is, whether it is based on performance obligation, whether it should be based on a period of time or should it be a point in time?
Yeah. So real estate has been, this is something which is with RERA and with the kind of different formats, that whether have I given a right to the buyer to exit even if the developer performs its obligation. So between both the models are available, that whether if I have given a right to the buyer to exit without my failure, then for sure it is at a point of time, because even if I was to complete all my obligation, but the buyer without reason can exit and I have to refund. So therefore these are the contracts between the developer and the buyer will have to be reviewed carefully for the purposes of saying that whether if is it following a percentage of completion, which is what they call over a period of time, and what is at a point of time. There is nothing which says that in a real estate everything has to be only at a point of time. This will be driven by way of a contractual arrangement between the buyer and seller, while the RERA standard contracts all says that if the developer was to fulfill its part of the obligation, the buyer will have to fulfill its obligation of paying for the purchase consideration. Only because the market prices have fallen does not give them the right to resign the contract, and therefore the developer will be right to ask for a specific performance. So both the models are available. Contract terms must specifically be looked at.
So then there's another very important question that we face in today's world, where in M&A often customer contracts, the customer lists are purchased. So when when there are customer lists with whom there are contractual arrangements, and then there are some where there are no contractual arrangements. So how do you treat the price which is paid for the acquisition?
So while the Finance Act on the direct tax, you are going to be busy whether it is goodwill or it is an intangible, and and how that will be handled. But as far as yes, it's an extremely important, because with the kind of activities on mergers which are happening either through a business combination where you are acquiring the customer list, which may be in nature of contracts, or which may be in terms of leads to the customer list. Both of these are dealt by the Ind AS 38 specifically, that uh, it can be your paragraph 9, obviously, which is the guiding factor, and one will have to look at the paragraph 68, that whether this customer list which are under contractual arrangement. So if I have an AMC and I have the arrangements, then those are contractual customer list, and there will be sub customer list which are by way of because I have some loose arrangement with the customers. They have bought something from me. I have some history, but I do not have a contract. And both of these are valuable assets. Both of them have to be independently valued. And if they are capable of being classified under both the buckets, they should be classified under both the buckets. If it cannot, then it will fall under the goodwill. So customer contracts can be classified, but they have to be segregated separately. Contractual and non-contractual cannot be clubbed together because both of them have a very different amortization and review policy. So that a lot of care, and we have seen that there are some challenges that many a times the companies are aggregating both, which will be a non-compliance with the standard.
Okay. Just one more question from my side, that when something has been classified as held for sale, and then later on the disposal plan is put on hold. In that case, especially if it is a current asset, in that case, how would that be treated going forward?
Yes, so this is something which many companies, even during pandemic area, are facing, that if there was a plan in March 20 classified as an asset held for sale, in the hope that during 2021 fully committed for sale, and there are multiple manners, right? So there are situations where I am committed to sell. I expect the sale to get over in 12 months. And as we know, the impact of putting an asset or a class of assets under intangible is that you stop depreciating those assets and you are carry forwarding at the cost or fair value less cost of disposal, and you stop depreciating any further. And there are specific requirements around where even as of March 21, what was classified as an asset held for sale in March 20 did not get concluded, because maybe the business dynamics underwent a change. Maybe the buyers who are willing to pay you that price are no longer available. You, in all sincerity, in all earnestness, one is looking at disposing the asset. So paragraph 26 to 29 specifically, one has to come back. Only because you have not sold under 20 within 12 months does not mean that you have to bring it back to PPE. But what the disclosure standard will require, that what further efforts are being done for the purposes of identifying the buyer, and if there is going to be even a further reassessment of the fair value less cost to sale. And it is quite possible that during this 12 months the entire business model has undergone a change, and so therefore one may not even be able to find a buyer. So therefore there will be a lot of rework which would be happening in this area, and I would believe that many companies will be faced with this challenges because of pandemic.
And there are some more questions which are on the screen. So would you like to answer any of these questions here? I think we have some time.
I may want to answer this question 5, because and I'm sure I have the benefit of Sumit also, that a lot of people read 1st April 21 as that this is amendments are going to have disclosure of schedule 3 1 2 3 will happen only in 21 22, but that's not how the schedule is read. Any balance sheet which are finalized on or after 1st April will have to comply. Sumit, in case you have a different view on the applicability of the amendment which happened yesterday.
Yeah, actually, can you hear me?
Yeah, Sumit, we can hear you.
Hi, good evening. No, so we are still looking at this, Sandeep, in terms of the specific applicability, and yet to kind of finalize our views on this. It's just come
Yeah,
hot off the press.
We have seen this while defining the Sumit, while drawing up the guidance note on the amendments of schedule on many occasions this applicability, because like in accounting standard, it very clearly says for accounting beginning on or after. But this is the audience has a very valid concern around this the question. But if the government wanted, or the MCA wanted this to apply from next year, I'm sure they would have not come up with the notification before the year. So this can be a matter of professional deliberations. But what I'm going to do, Drushti, is that if some of these questions which are there, we have the occasion also for the next 2 days, I can always come up with some of the questions, but I will not want to. I promise Sumit that I will end at 6:30 for him to kickstart. He is lot to share, and I'm a keen listener to his presentation. So thank you so much.
Thank you, Sandeep bhai, so much for this wonderful insight and so many issues that you brought up before us and discussed very much at length. I now request my regional council colleague, C.H. Chintan Patel, who is also the chairman of Ind AS committee at WRC, to propose a well-deserved vote of thanks for Sandeep bhai's session. Chintan, we cannot hear you.
Thank you so much, Darshi. She has done fantastic efforts to organize this 2 days workshop. And one of the most important thing which is for workshop is that just to cover very critical points, not touching upon everything detail, but just to cover the practical issues. And when I was going through Sandeep Shah's his session, it was fabulous. Sandeep ji, you have covered very important topics, very important issues. And the main crux of the session, which was the touching upon the practical issues, that was very well covered. So thank you so much, Sandeep bhai, for sparing your valuable time. And we look forward to again welcome you in future sessions of WRC. And with this brief word, I hand over charge to Darshi bhai.
Thank you, Chintan bhai, for the wonderful vote of thanks. And I can say that Sandeep bhai has always stood by the institute, and he has always helped us in all our efforts. So thank you, Sandeep bhai, again for this. Now moving on, we have the next session, where again there will be several Ind AS issues covered, and we have a very dynamic faculty for this session, Sumit Seth. And now may I request Chintan bhai to introduce the speaker for the next session, please.
Yeah, thank you, Darshi. I know Sumit for so many years because we have been in the same field. But today when I look at Sumit, I felt something different. So the way I have seen Sumit, the way he has dealt with earlier, and the way the impression in my mind, today I see that I thought that he must be in USA and doing a lot of MNC's work, handling many clients. Is it so, Sumit?
I'm still in Bombay. I'm at my home, but yes, I'm handling them from home right now. Yeah.
Great. So okay, he is a partner in assurance practice of PwC and has over 23 years of experience providing professional services to public and privately held companies. He leads capital markets and accounting advisory services practice in India and has extensive experience of working alongside companies on a very wide range of transactions. He also leads, or he also is a national technical leader for US GAAP and US gas reporting for PW in India. This is what he's been. There is a lot of things are there which we have to say about Sumit, but I'm not talking very much detail. But he has been regularly available for ICI seminars, workshop. He is a regular speaker. He also has a publications and training in his own name. So again, fortunate enough to have Sumit with us. And you have very good topics, and 116 is there on your list. So we all are eagerly waiting to listen to you on a particular aspect here. So now with this handover charge to Sumit.
Yeah. Thank you. Thank you, Chintan, for the introduction. Hi, Drishti and Sandeep. It's always a pleasure to listen to you, and the way you quote the various paragraphs of the accounting standard, I think it's fantastic. I'm not sure I'll be able to do that, but anyway, first of all, it's great to be here, and I see many participants, so that's really nice. What I will try and do is, or what I've tried to do is really cover some of the practical issues which maybe I've come across as we're working through clients. We try to put together some of the observations from the EAC opinions, which we thought was relevant, and of course, like Sandeep also spoke about some of the IFRIC tentative agenda decisions, which I thought may be important. So that's how I tried to structure it. I've done it more like a question and answer and with examples. But I'll be happy to take questions. I think that's most important. So I'll try and see and leave some time for questions. So maybe with that, once again, thank you WRC for having me here. And let me maybe start off with my presentation or the PPT which I have. Chintan, how do we do this? Should I kind of put it up, or is someone else will help putting it up? I should put it up, right?
So if you, generally you should put it up, because I don't know if you shared the presentation.
Okay, I'll just put it up. Okay. Can you see?
No.
So just give me a minute. Okay.
Yeah. Visible.
Yeah. Okay. The only thing is I have to find a way to. Okay. Okay. So maybe. Yeah. Okay. So can you see the slides?
Yeah, it's visible.
Yes. Yes.
Okay. So the first one, is on leases, and I thought this is a pretty interesting question, because it comes down to the real fundamental of what is a lease, whether an asset which a company is using is a lease. So really the scoping of the lease, and the matter here is really as an example, entity X enters into a contract with entity Y for a period of 5 years. To use a particular aircraft, and the contract details the interior, exterior specifications. It also contains, the contractual. Actually, I'm not able to. One second. Yeah. It also it specifies the interior and exterior specifications. It does contain certain contractual and legal restrictions as to where the aircraft can fly. However, subject to these restrictions, entity X decides whether, where, and when, and for what purpose the aircraft will fly. Having said that, entity Y operates and maintains the aircraft using its own crew. So the question really is whether entity X has a right to control the use of the aircraft. So as we know, the definition of a lease really is that an entity should be able to control the right to use the asset, basically obtain substantially all the economic benefits, and most importantly, be able to make all the relevant decisions in terms of how and for what purpose that asset should be used. So really, if you look at this, actually, this is again derived from a tentative agenda decision. The question came up is that since the supplier or the lessor is actually operating and maintaining the asset, and also since the supplier, the lessor, has specified certain restrictions, can this really be a lease, from entity X's perspective? and this was, like I said, it was dealt with by the IFRIC committee, and as part of their conclusion, actually, just one second, I'm trying to I'm finding it difficult to move this forward. Yeah, hello.
Yes, we can see. We can see now.
Okay, good. Yeah. So if you look at this, yeah. Okay. So if you look at this, the analysis is that this is a lease for entity X's perspective, because it can make all the relevant decisions, in terms of how and for what purpose the aircraft can be used, where it can travel, when it can travel. Though there are certain restrictions, but those restrictions really define the scope of the asset or the scope of the lease. It doesn't really impact the ability of entity X to, derive substantially all the economic benefits. And the other aspect is, again, with respect to entity Y, which is the lessor, operating or maintaining the asset. Again, that is maybe an important aspect, but again, doesn't really impact, how one derives the economic benefits from that. It's more of, I would say, protective rights, which the lessor may retain. So again, important question, an important item dealt with by the IFRIC committee. And the real idea is that there may be certain aspects of a lease which may be predetermined. Having said that, there would still be many aspects of, how, for what purpose, whether the lessee can make changes, which may impact the ability to derive the substantially all economic benefits, and therefore it may still be a lease. Many times the discussion has been, look, if some of the activities or the relevant decisions are predetermined, therefore can it really be a lease or not? And I think the IFRIC dealt with it on that basis, that you have to still consider, after having looked at the predetermined decisions or activities, what is the residual, and whether that can impact the rights and the ability to derive economic benefits. So I think that was the point. And you may see, many contracts like these where there may be some decisions which are predetermined. There are some decisions which are left, but so long as the remaining decisions which are left are important, and provides the lessee an ability to derive those economic benefits, earn profits, etc., that may still be good enough, for a conclusion that it is a lease, and therefore the lessee should kind of bring it onto the balance sheet. So I'll move forward. This is again a very important point, and this comes into what is the lease term. So something similar was dealt with by IFRIC as to, how do you consider, the lease term in terms of, what is the enforceable period, basis that, how do you consider the non-cancelable period plus the renewable options, etc. So I'll try and give this example. Here we have a situation where inception of lease is, April 1, 2020. The initial lease term ends, at the end of 5 years, which is March 2025. That's kind of the non-cancelable period. And thereafter, there are 2 renewable options of 5 years each. And those options, there are no penalty on termination, as such. And having said that, there is an important fact pattern here, that this company's board, has approved a manufacturing plan for 10 years, which is up to 31st March 2030. The location is critical. There are other commercial arrangements, signed for 10 years, the exit of which will lead to significant penalties. Now, if one thinks about it, the most important element in the leasing standard is the lease term. And the lease term being, the non-cancelable period plus, the option to renew, which is reasonably certain at inception. and an option not to terminate, right? Now, when you look at that, there are certain factors to consider while making that determination. And those are, what are the terms which have been negotiated vis-a-vis the market terms. So, for example, in the kind of renewal option period, are those terms more favorable than what you would expect the market would be as we know now? Are there kind of penalties, of course, on termination? Are there significant leasehold improvements you made, basis which you will want to continue for a longer period so that you can derive economic benefits from the use of the leasehold improvements? Are there any, relocation costs, dismantling costs, renegotiation costs, etc., right? So the concept of, like you said, is there going to be more than a insignificant penalty, for in case you terminate? If the answer to that is yes, there is, then your lease term will be for a longer period. Now, again, the concept of penalty is not just the amount of penalty which is probably mentioned in the contract, but it's a more, I would say, broad concept and an economic concept, which needs to be considered. So in this example, the view would be, what would be the lease term? Clearly, if you look at this, the 5 years primary lease period or the 5 years non-cancelable term is clear. But over and above that, because of these other aspects which are mentioned, like the board approved manufacturing plan, the location being critical, there are other contracts which have been signed, for a period of 10 years. And if you exit those, there could be implications. The answer would be that, in this case, the lease term, would be for a period of 10 years. And of course, as you know, that's important because, when you take up 10 years, the lease term, your right of use of asset amount and the lease liability would be obviously a higher number. So this is again an important area. And in fact, the IFRIC discussed something similar to this as to, when you have leasehold improvements, and you have a kind of a primary non-cancelable term, but there is leasehold improvements which go beyond that term in terms of the estimated useful life of those leasehold improvements. So then how you should consider it. And again, it came to very similar concepts of looking at the broad economics, of the arrangement as to when we talk about penalties, it's not just the contractual penalty, but more kind of business-oriented aspects also which you got to consider. So that's on the lease term. I think one of the most basic principle, but the most important principle, because basis this is what one will determine the amount of asset and the liability. I'll move forward. The next one here, which is on sale and leaseback with variable payments. Again, an interesting issue, an important issue. One could see more of this now in recent times because as due to the COVID pandemic, the lease payments are kind of moving towards more variable type payments. But let me try and come to this issue here. And the issue really is, to kind of start before getting into the details of this issue, if you look at the lease liability, the definition of a lease liability is, of course, the present value of the lease payments over the lease term. But one of the important aspects is that when you have variable lease payments, linked to, let's say, revenues or something else like that, that is not considered in determining the lease liability. So I think that's kind of point number one, which we should just keep at the back of our mind as I move through this. So coming back to this this specific situation, there's a sale of an asset and then a lease back. Right now, let's take this example here. An entity seller lessee enters into a sale and lease back for an item of an asset. Let's say the lease back period is 5 years. Of course, the sale meets the definition of IFRS 15 or Ind AS 115. Let's assume that the consideration is at market or at fair value. Also, the lease payments, which are variable, means they're not fixed, and they are based on percentage of sellers lessee revenue, generated using those assets. And the lease payments are not considered fixed or in substance fixed because they are truly variable. They will depend on the revenue generated. Now, the question here is, how do you account for this? Now, typically, as you see in this standard written here, para 100 of Ind AS 116, when you sell an asset and you lease back, the standard would say you should recognize gain to the extent you have transferred the rights in the asset, and you should not recognize gain to the extent you retain, the rights or the interest in the asset. Right? Now, in this situation, so when you do that, here was an issue of how do you recognize really, the gain, because the amount of your lease liability is truly variable. We don't know what's going to be. It is going to be based on the expected sales. We don't know what the sales is. So therefore, should we recognize no gain, or should we recognize the entire gain? Because it's very hard to say, how much is the lease liability to be recognized, and therefore how much of corresponding right of use assets should be retained on the balance sheet. So this was a interesting kind of question which came up, and actually there have been diversity in practice in this. I know companies prior to this being clarified, they recognize the entire gain, because there was no lease liability technically, because the way the lease liability is defined in the standard, and these were all variable lease payments. So therefore, companies would have and have recognized entire gain, and therefore this issue came up to the IFRIC, and they have clarified that even though the liability, which will come up in terms of future payments, is variable and it's not fixed, but you must make an estimate of what those expected payments could be, and to that extent, you recognize the liability, and therefore, obviously, you would defer, some portion of the gain, which is proportionate to the right of interest, right of use asset which you have retained. So this is a pretty, I would say, a change, interesting example. Also, it was slightly controversial as to whether this really meets the definition of a lease liability, because its payments are not fixed. But I think the ISB has looked at it, they've thought through it, and finally that's the kind of answer. So just to way of an example, let's take the example here to maybe illustrate what I've been saying. The PP carrying amount is 10 lakh rupees. Let's say the sale price is 18 lakhs, and let's say the present value of expected payments, which is the lease payments, is 450,000. Right now, if you look at this, the present value of the lease payments to the fair value of the PP, the fair value being 18 lakhs, is almost 25%, right? 1/4. So what the IFRIC, what the ISB said, that in a way, what you've done is, you have sold, or you have given up 75% of the interest. You have retained 25%, because though you sold it for 18 lakhs, you are going to pay 4.5 lakhs again at a later point in time, over time. Therefore, you really retained 25% of the property, plant, equipment, and therefore you should not recognize the entire gain, which will be 18 lakhs less 10 lakhs, but you should recognize 75% of the gain, and 25% of the gain you should not, because you are retaining that much of interest in the form of ROU. So I think that's a big, that was an interesting kind of comments which we saw, but there's something to look out for if you do come across this in practice. So ROU asset, what is retained, 25% of 10 lakhs. The gain which will be recognized will be 75%, because that's what you've really given up, and that is 6 lakhs, which is 75% of 18 lakhs being the sale price minus 10 lakhs of cost. And of course, the difference, would be is your liability, which you will retain in the books. So this is a topic which did come up. I thought I should cover it. And in case there are any, questions, happy to take on that. Just before I move on to the next topic, which is Ind AS 101, I think, as we look at the year end, the other area which one may want to look at from a leasing perspective is the amendment around rent concession. As you know, because of COVID, there was an amendment that if there are any concessions which are given by lessors to lessees in the form of, either deferral or really, remission of liability and kind of a waiver of liability, then one has a choice to account for them, as variable payments. Therefore, really speaking, you could recognize them as income statement during the period itself, instead of doing a modification accounting and adjusting the ROU assets. So I think that's one, I would say amendment which is there, which one should look at. And I understand that ISB is further extending that for one more year up to 2022. And I believe even, Institute has either already published exposure draft on that. So I think that's one area which one may want to look at from a leasing perspective, at least for this year end. Moving forward to 101, again, I'll try and illustrate this in the form of at least a practice matter which came to my attention. So Entity X, if you look at 101, there are many exemptions and exceptions and exemptions. One of them being goodwill, where if the before transition to Ind AS, company has a choice not to go back and restate the goodwill. So this question is really around that. And let me try and explain the facts here, which is Entity X will be presenting its first Ind AS financial statements for the year March 2021. Of course, the date of transition will be 1st April 19. Entity X has acquired one business pretty much every year from 2015 to 2020. And it has accounted for that in accordance with previous Indian GAAP, which is, AS 21. Now, Entity X intends to apply the business combination exemption under 101, and so it will not restate any business combinations in the year from March 15 to 17. However, it wants to restate the accounting entries that it made in accordance in accordance with 103 for the March 18 business combination, but it does not want to restate the acquisition made in March 19 and 20. So the question really is this in accordance with 101? So just to kind of, maybe explain, the company wants to take like a cutoff. They want to not restate the business combinations, up to 17. They want to restate for the year March 18. But again, when after that 19 and 20, the company didn't want to do it. So is this in accordance with 101? And of course, the answer is no, it's not. Once the 101 would say you can restate, you can decide and pick up a date up to which you don't restate the business combinations as per 103, Ind AS 103. But once you've decided that date, thereafter, you have to restate all the business combinations in accordance with Ind AS 103. And you cannot pick and choose, once you picked up a specific date. And clearly in this fact pattern, for the year 2020, which will be the comparative year in the first year of adoption, being a comparative, it clearly has to comply with Ind AS. So there was no way that you would not be able to. So that was a point just from a 101. I thought I'll give one example of a business combination issue which came to my attention. I'll move forward to Ind AS 34, and that is on interim financial reporting. Now this is again a very interesting standard. It's of course really relevant for quarterly reportings and for predominantly listed companies. I've tried to take an example for income taxes. Now, as we know, under Ind AS 34, income taxes is actually one of these, I would say, an exception to the otherwise Ind AS 34 in terms of measurement and recognition. And when I say that is under Ind AS 34, really when you do quarterly accounts or interim accounts, the recognition and measurement principles which apply for interim reporting are really the same which apply during annual financial statements. So there are no differences. So if something is got to be an asset, then it's got to be an asset assuming it was the year-end accounts. If something's going to be a liability, it should be the same as if you're preparing a year-end accounts. In the sense, you cannot defer or you cannot advance recognition of assets or liabilities. It's got to meet the same recognition and measurement principles. But income tax is an interesting area where, and the income taxes for interim accounts, it really says that you don't do a hard cutoff at the end of each interim period or quarter. You really try and estimate what's going to be the effective tax rate for the year. And based on that effective tax rate, you apply it to the accounting profit each quarter or interim period and come to the tax expense. So really, income tax, I think, is one of those areas where it in a way moves away from the typical recognition and measurement rules, from an Ind AS perspective, because it says you got to do as a effective tax rate. You look at what the year-end expense or credit is going to be, and then apply it to the quarters. So I thought I'll take an example here because this is something which has come up in practice, where you've got, let's take two half years, H1 first half year and H2, and specifically this issue is more when you have one-off discrete items, or here I've taken an example of one-off tax disallowances, right? It is happening every quarter. It happens also sometimes when you may have exempt incomes. Let's say dividend income has been received in one quarter but not so in the other 9 months, etc. So if you can look at some discrete events and how do you consider taxes. I've taken an example here of disallowances. So if you hear, as you see, the first half year is a 5 lakh rupees of, let's say, loss. Second half, it turns out that it's a profit of 5 lakh 50. At the end of the year, it's a 50,000 net profit. But interestingly, if you see the disallowances and the tax, in the first half is 140,000, in the second half is 160,000, and overall 300,000. Now, when you look at taxable profit, it's quite interesting. In the first half, you'll have a taxable loss of 360. In the second half, taxable profit of 710, and overall you have a taxable profit of 350. Let's assume for a moment there are no other temporary differences, and this is only the permanent items, the only items right now. So if you see this, the tax charge obviously on 350 at the end of the year, applying 30% rate comes to 105, and therefore your net loss after tax would be 55,000, which is 50,000 of profit before tax, and a tax expense of 105, and therefore a loss after tax of 55,000. Now, when you try and apply an effective tax rate, really what it comes is on the right side. If you see in the screen, your tax expense is 105, the profit before tax is 50,000. The effective tax rate, when you consider the disallowances, is 210%, right? Whereas when you don't consider the disallowances, obviously it would just be 30%, right? Which is 15,000 over 50,000 of PBT. The real increase in tax expenses coming because of the disallowances. Now, if you would have to go forward and using the principle of effective tax rate of 210% for the year, if you would do that and apply it to the first half and the second half, you see the results appear quite distorted, and you see it down here. In the first half, we have a loss of 500,000. If you apply a 210% ETR or effective tax rate, you get a tax credit of 10 lakhs 50,000, and you end up in a kind of a net profit of 550. And similarly, in the next half, you will have the company will have a profit of 550, and then of course, a loss after tax of 605, and so forth. So you see the results look quite distorted. Whereas what one could do here is that instead of applying 210% tax rate, you could do it maybe hello. Hello.
Your screen's got, I think, shifted. We can
1
see.
second.
सर इसको मिनिमाइज हाँ 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 वही क्लिक करिए सर
किसको?
हाँ हाँ इसी को सर
This is
हाँ ये ओके
yeah
ये पीपीटी है ना सर
okay हाँ यही है
हाँ सर ओके
okay 1 second इसको minimize कैसे करें? Okay yeah okay sorry about that. So instead of applying a 210%, what one could do is really apply the 30%, which is exclude the effect of the discrete items and take that separately. So if you see on the bottom right hand side, one could start with then a same example, 500,000 of loss, apply 30% to that, excluding the effect of disallowances. So you come to 150,000 of credit. Then you apply the 30% tax on the disallowance completely in that quarter, which is 42,000 here, now being nothing but 30% into 140, and then you come to your taxes. So you see the result is a slightly, I would say, more realistic, where you start with a loss of 500 and you come to a net loss of 392. Similarly, in the second half, you start with a profit of 550. You come to a net profit of a tax of 337. Whereas if you see on the left side, you would start with a loss of 500,000 and you get into a profit after tax of 550, right? So I think this is one area, it is actually not uncommon, but something to consider when you do have, significant and material discrete items on taxes in a interim period. You can try and, give the effect of those discrete items specifically and apply the ETR on the rest of the profits. I'll move forward. This is another issue which we face. This is again a situation of volume rebates, and this is from a seller's perspective. And the example I have here is a company really preparing the 6 months results. The company is offering rebates on sales based on certain volumes. If you sell up to 100,000 liters, no rebate. 100,000 to 250,000, 5% rebate on all sales, and over 250,000, then 10% rebate. So, the particular customer has purchased 140,000 up to 30th September. The customer has a history of purchasing, more than 250. So, at in the half year, let's say 6 months, and it's September 30, 2021. Whether the company should accrue, a rebate at the rate of 5% because, it's within 100 to 250 liters, 250,000 liters, or should it apply, a 10% because it knows that by the end of the year, is going to be, more than 250,000. So really the answer here is that, of course, it would be 10% because the standard here in a way also links it back to Ind AS 115. When you know that the most likely outcome is going to be that you will end up paying 10%, and that's the kind of amount for which it is highly probable that a significant reversal of revenue will not occur, then you take that amount, which is 10%, and you accrue it in relation to sales made up to the half year ended September 30th. So again, something to consider, and again, not very uncommon. I'll move forward. The next topic is, exchange rates, Ind AS 21. Now, here again, the example really is around non-monetary assets. I think this is a very typical area, which we see, in many situations. So, first of all, when we look at foreign exchange rates and foreign currency transactions, of course, you reinstate the year-end balances and recognize generally the foreign exchange gain losses in the income statement. But it's important to remember that what is getting restated is the monetary assets and liabilities, and not really the non-monetary assets and liabilities. And what comes up is that as to whether an item is monetary or whether item is non-monetary. Now I'll just go to the basic a little bit that monetary items are those where you would settle the liability or receive the amount in a fixed or determinable currency. So typically, simply said, where cash would be exchanged and non-monetary would be otherwise. So typical examples of non-monetary items would be, of course, property, plant, equipment, goodwill, inventories, and the areas where we slightly may have misapplied, I feel, items like prepaid expenses, advance to suppliers, advance from customers, deferred revenue. Maybe there would have been diversity in practice. Maybe people have misapplied it, but really those being monetary items, do not get reinstated, and therefore they do not result in any foreign exchange gain or loss. So here the question really is, should entity A translate the advance given to supplier? And the answer is no, it should not, because it's a non-monetary item. And of course, because it's not expected to be settled in cash. There's one more aspect here that I think maybe a year or two ago, there was an amendment to Ind AS 21, and where it said that once you have in this fact pattern, for example, on let's say on April 21, when or let's say July 1, 2020 in this example, when the advance is paid and the exchange rate is 74. Like I said, this will not get reinstated, right? Now the question is, when you don't reinstate this, when actually the goods are supplied on, in this year, in April 1, 2021, at what amount should that inventory be recognized? Should it be at 74, which was the amount price at which the advance was recognized, or now when the inventory is received? Now again, there probably may have been diversity in practice, but really speaking, in my mind, there should not have been, because once we're saying that these advances are non-monetary, and it's not expected to be settled in cash, and therefore it should not be reinstated, then all along the advance amount would be at INR 74. And therefore, when you really receive the inventory, you would recognize that at 74, because that's what your advance was. So ideally, there should not be any change or any difference, but maybe there was diversity in practice and people may have done some differently, and therefore there was a specific amendment that in situations like these, where you have advances for supply of goods, or you have deferred revenue or advance from customers, the exchange rate which you would consider for recognizing the related revenue, expense, asset, etc., would be the initial, the date at which the advance was paid or received. In this case, it would be at INR 74. So that amendment came up, in Ind AS also, and in IFRS is the IFRIC 22, which got released. So that's on this non-monetary items. Again, matter to remember, consider. Sometime it gets missed out. Okay, I'll come to the next one, and this is again an interesting one where we've got exchange differences with respect to intercompany loans, especially in the financial statements, standalone and consolidated. So I've taken a example, a fact pattern here. You got holding company in India. It has a subsidiary in India, also a subsidiary B in US. The functional currency of the Indian holding company is rupees. Of subsidiary A is also rupee, but subsidiary B is USD. Now, subsidiary A gives a loan of USD 1 million on April 1, 2020, to subsidiary B. And, at that time, the exchange rate was 74 rupees for a US dollar. And now we're looking at year end, March 31, 2021. The rate, the rupee has strengthened, and now it is 70 for 1 USD. So the question really is, how do we account for this in the standalone financial statements, in the consolidated financial statements? So I've tried to put all the scenarios here. Now clearly, in the holding company's standalone financial statements, of course there's no impact because it's a transaction between the subsidiaries. But let's take standalone financials of subsidiary A. Of course, for it, the subsidiary A, it's an asset, it's a loan given. Now, being an asset, you've got an exchange loss which is coming in. In this factor which subsidiary A will recognize. Subsidiary B, it doesn't matter because it's a functional currency is dollar, and the loan also, which has a receipt, is in dollar, so that's no impact in subsidiary B's financials. But in the consolidated financial statements, now the question really is, should that loss, which is recognized in subsidiary A financials, will it continue or will it not continue in the consolidated financial statements? Sometimes people think that, look, it's an intercompany transaction between subsidiary A and B, and therefore, this exchange difference should get eliminated. But the reality is, because, the two subsidiaries have different functional currencies, there is actually a foreign currency risk which has been created in the consolidated financial statements. And therefore, that exchange loss which subsidiary A recognizes in its standalone financial statements continues also in the consolidated financial statements. So that's an important point, because it's a foreign currency transaction between two subsidiaries having different functional currencies, and that has created actually a foreign currency risk for the group. The point which I have, another interesting point here is, which I have not necessarily put on the slide, but let's, I'm just going to add a twist to this. Let's say, for example, the subsidiary A, the loan which is given, it is neither, planned nor likely to be settled in the foreseeable future. So something like a, net investment in a subsidiary. The question really is, in those circumstances, this loss which has been recognized, can that be, taken to the foreign currency translation reserve or other comprehensive income? And the answer to that is yes. Now, even though the parent has not given the loan directly to subsidiary B, and even though subsidiary A has given it, though in the standalone accounts, it would be a loss recognized in the income statement of subsidiary, but in the consolidated accounts, if this loan is neither planned nor likely to be settled in the foreseeable future, then it could be recognized, or it should be recognized, in other comprehensive income, in equity and not in income statement. So I think that's again, something which comes up, that in the standalone accounts, it is in the income statement. In certain situations, in the console also, it will remain in income statements. In another scenario where it's considered like a net investment, long-term loan, then it will still get recognized in the standalone accounts of the subsidiary, but in the consolidated accounts, it will go as part of other comprehensive income. So again, to watch out for, depending upon how the transactions are actually contractually structured. I'll move forward. This is moving on to the area of borrowing costs. Again, very, I think, close to our hearts. This matter, I'm quite sure we see it. for a construction business. But let me get down to this example where again, this is based off the IFRIC's tentative agenda decision, and they've covered this. So here again, the facts in a simple ways: company A acquires and develops land. It's also thereafter constructing a building on that. Both land and building meet the definition of a qualifying asset under Ind AS 723, and entity A is using general borrowings to fund the expenditures on land and construction of building. Now the question really is, should entity A cease capitalizing borrowing costs in respect of expenditure on the land once it starts, constructing the building, or should it continue to capitalize borrowing costs incurred in respect of land expenditure while it's constructing the building? Really saying the crux. So the question is really, if I break it up into parts, should this company, which wants to construct a building on a land, look at land as a separate unit of account and building as a separate unit of account for purposes of capitalizing borrowing cost? Or should it think of it as one unit of account, at least for the purposes of capitalization of borrowing cost, and cease capitalizing borrowing cost only when that entire unit of account is complete? That's kind of in a simple way. And really the answer is, if you look at Ind AS 23, it says you should cease capitalizing borrowing costs when all the activities that are necessary to have the asset ready for its intended use, so that's capable of being used, right? Substantially all the activities are completed. Now here, what the IFRIC said, look, you've got to look at what is the intended use of land. Is it just the land by itself, or is it the land and building together for purposes of your own kind of use, maybe for renting it, maybe for sale? So what is that intended use? Can the land just be used? Is the land, when the development of land is completed, is it capable of being used for that intended purpose, right? And if that intended purpose is not piecemeal, but the overall land and building together, then one should not cease capitalizing borrowing cost until the building construction is completed and that entire unit is ready for the purpose of intended use. Therefore, you would continue to kind of capitalize borrowing costs even on the land development expenditures, even though there's nothing much which is happening on the land and it's more on the construction of building which is taking place. But because you treat them both as one unit of account, in a way, you would continue to capitalize it and consider that as a qualifying asset until the unit is ready for its intended use. So that's an important one. I'm quite sure we'll have these examples would be quite common actually in our clients and other situations. I'll move forward. This is another thing which has come up, again, a very practical issue, and I believe there was an amendment, in the standard Ind AS 23 and IS 23. Now, really, here these 3 or 4, I would say, points which I wanted to make. One is when you look at the borrowings to be considered for purpose of capitalization, there are 2 types of it, of course: specific borrowings, and then which, other than specific, everything becomes a pool of general borrowings. Now, really, when you look at capitalization of borrowing cost, when you consider obviously the borrowing cost with respect to specific borrowings in relation to capitalization on those assets which are getting ready for, which are undergoing, activities to get ready, right? And therefore, to that extent, you don't consider those specific borrowings for capitalization of other assets. Now, the question really is, there are situations where, an entity would have borrowed funds specifically to obtain an asset other than a qualifying asset. So let's just take an example. Someone goes and borrows to acquire, an subsidiary, right? Subsidiaries can't be a qualifying asset because you're not constructing it. You're not, doing activities to get it ready. But you have a borrowing, and at the same time, you're also, undergoing construction of a plant, right? Now the question is, the borrowing was taken to acquire the subsidiary specifically. Separately, you're also constructing a plant. Now, does that mean that just because that's a specific borrowing for another purpose, you will not consider it for purpose of capitalizing? That's the kind of question which was asked. And the answer is, you may have taken a borrowing for a specific asset, but if that asset is not a qualifying asset, then that borrowing becomes part of the general borrowing. So I think that's a very important point. So in this example, which I just said, though an entity would have taken a loan just to buy another investment, and that investment obviously is not a qualifying asset. But at the same time, if there is other construction work happening at a plant or somewhere else, because that borrowing is outstanding, that will become a general borrowing, and the interest cost on that would be considered for capitalization. Because the concept of Ind AS 23 is that, if you would not have incurred the capital expenditure, hopefully you would have had money to pay off the borrowing. Because you have incurring capital expenditure, you're not able to pay off the borrowing, and therefore that borrowing cost should be considered for capitalization. So that's kind of the concept of, as you may say, the concept of avoidable cost of borrowing, and therefore it should be capitalized. So that's point number one. And I guess the other point is, there will be times when you would have a specific borrowing for constructing a qualifying asset. Once that asset A, for example, is ready and operational, obviously you cannot capitalize interest on that. But then that borrowing for the specific qualifying asset now comes back in the pool of general borrowings, and therefore it will then be used or considered while capitalizing borrowing costs on any other qualifying assets. So I think these are important points. Maybe people may have misapplied it, misunderstood it, but I think now that's pretty clear. Unless the summary of this is, if you have an outstanding borrowing, if it is not related to a specific qualifying asset which is under construction, then that borrowing becomes part of overall general borrowing. So, for example, lease liabilities for ROU assets, they are also liabilities. They are specific to a right of use asset, but there may be some other asset which is getting constructed, and therefore the interest cost on these lease liabilities would get capitalized on those other assets which have been constructed. So again, important concept, to consider, that so long as there are borrowings outstanding, and if they are not for a specific asset which is undergoing construction activity, then they become all part of borrowings, general pool of borrowings, and therefore should be considered for capitalization. I'll switch gears. I'll move to Ind AS 37, right? And here really, again, an example which we have seen on restructuring. Now, under Ind AS 37, one would consider restructuring provisions and would recognize them as an expense, in the income statement. The question really is, the timing of recognition. And really, in practice, I have seen, these items, just depending on, how it is communicated, when it is communicated, the provision to be made really can move from 31st March, year end, to the kind of next year. So this fact pattern is as follows. Entity is planning restructuring of a factory. Year end is March 31, 2021. The entity has made an announcement on January 1, 2021 about the restructuring. including the functions and the number of employees likely to be affected. There's a 90-day consultation period with the employee representatives. However, the individual employees were not notified by year-end. They were only notified after the year-end. The question really is, can this entity provide for restructuring cost? And again, the answer is yes. So long as the company has started the process, it has the board has authorized it. It has made communication to the employee, let's say representatives or union, even though specific employee communication has not been made, and the plan terms have been communicated in sufficient detail, then one would recognize this as a provision at year end and not necessarily wait until every employee is communicated. Of course, one would have to see that the negotiation which may be happening or the discussions which are happening, how substantive they are. Are they really more about the terms, or is it something which could fundamentally change the entire plan? In which case the answer could be different. But typically, so long as the board has approved it, there is a communication more broadly. It kind of creates a constructive obligation. That means the employer may not have a realistic ability to really go back from that and would have to honor its commitment. So one would then accrue for it in 31st March 2021 itself. Like I said, this is an area, just because of the way and the timing of when the communication takes place, the accrual could really be made, or the accounting of the expense would move from one year to the next year. So it's a pretty I think important area to kind of consider. The next one, this is again a very interesting one in practice, where you got like insurance to deal with. So here the example which I have put out is, look, you got an entity whose plant has been destroyed due to fire in January 31, 2021. It has an insurance policy which covers damages. It's filed a claim March 2021. The survey is still in progress, not completed. But management believes that they should be able to recognize an insurance receivable as an asset because it has a valid insurance policy. The claim is covered in the scope, and the company also has obtained a legal opinion stating that it is virtually certain that insurance claim is recoverable. Now, this is again a question of Ind AS 37. If you see, liabilities or provisions are recognized when it is probable that there will be an outflow of economic resources, right? Probable is generally more likely than not. More likely than not means generally 50% and above. For recognition of asset, and especially a contingent asset, the threshold is virtually certain in Ind AS 37. And we know this from the concept of virtually certain, in the AS 22 for, income taxes, recognition of deferred tax assets. So virtually certain is a very high hurdle, right? Now, the question here is, when should the company recognize an asset? Is it okay based on these facts to recognize the insurance asset as of March 31, 2021? And clearly the answer is no. Typically here, even though, you have a company has a valid insurance policy, the claim is covered, we believe, we will get certain amounts. The fact is that there is still uncertainty. The survey is not complete. It's not in the entity A's control. It is on the insurance company's, view as to how much is the amount of claim. Very difficult to estimate it. So the answer here would be that in this fact pattern, the virtual certainty would not have been established as of 31st March 2021, and therefore an insurance asset should not get recognized. Clients come up and say, many times they will say, look, okay, it's not happened as of 31st March 2021, but before the accounts are finalized, and I'm taking another hypothetical scenario. Let's say May, the insurance company comes up and says, we accept your claim. The companies, clients and companies will say, then let us recognize that as an asset. Let's consider it as a subsequent adjusting event. and now you have the answer to the amount of claim. So now can we recognize it? The answer is again no, because as of 31st March 2021, it was not virtually certain, and this cannot be considered a subsequent adjusting event. So again, insurance claim accounting for it, I think got to be very careful. It's quite judgmental, and of course, it is surely based on facts and circumstances. But I'm just giving you one example, one scenario. The next one, which I thought I'll cover is on ESOPs. Maybe I'll move slightly quickly. Keep being conscious of time. Here, another area which we see in practice, where a company grants options to employees, and in this fact pattern, 25% of options vest each year, and employees will of course exercise the options over after 5 years. The question is, how do you kind of recognize the expense? In this case, I've made it simple. I've assumed 1 rupee per option is the fair value. Now, really, if you look at it, under maybe Indian GAAP or the previous guidance note, there were probably both 2 methods. Either you do straight line, or you do the graded, or as we say, accelerated vesting. And but now under Ind AS and IFRS, you have to do accelerated vesting or graded vesting kind of basis. So what that means really is that your total expense is 2,400 options into rupee 1. Now question is, do you recognize the 2,400 divide by 4, because 25% is vesting each year, and just do it as 600 every year, and 600 into 4 will be 2,400, or the way it has been put out in this last column E here, which is you've got to do it for each vesting, each tranche which is vesting. So in this example here, tranche A, 600, which will vest over 1 year. Tranche B, 600 divided by 2. Tranche C, 600 divided by 3. The 3 and 2 are the years, and 4, etc. So you see the amount of expense which gets recognized in the first year is almost, pretty much 50% of the total cost, and then it kind of, scales down because more and more is vesting, right, in the initial part of the overall vesting period. So again, something to consider. It gets missed out sometimes. People may think that we can just spread it out equally over 4 years, but no. The answer really is you have to do it on a graded basis, or in other words, on an accelerated basis. So the attribution of expense will be higher in the earlier years, and then it's kind of taper down. I'll move to the next one, and this is again a pretty interesting one, I would say, where we have group-based share payments, and there is not so much of, I would say, written guidance in the standard on this, but maybe I thought I'll try and cover some examples. So I've got I try to put here example. You have a holding company and you have a subsidiary, and employees of subsidiary are eligible for share options of holding company. So that kind of left side is what the fact is. Now you may have 2 scenarios. Now the 2 scenarios being, if the holding company cross charges the expense to subsidiary, which is on the left side, the 2 boxes. On the right side is if the holding company does not cross charge the expense. Now, when you look at it from the subsidiary's perspective, clearly, Ind AS 102 would say the subsidiary has to recognize an expense because it's the employees of the subsidiary who's providing the services, and the parent is really acting like a parent and giving that indirect benefit to the subsidiary. So it's like capitalizing it. So the answer here would be, as I'm going to look at the box, the left side box at the bottom in the books of subsidiary, because that's a starting point, because that's where the expense gets recognized, because the subsidiary whose employees providing services. So what the subsidiary would do, it would determine the fair value of the awards or options of the parent. It would recognize employee share-based expense, credit share option reserve. If the holding company now cross charges then it would basically debit that reserve, credit payable to holding company, because of course it has to pay the amount to the holding company. So that's kind of, fact one. The expense in the books of subsidiary is not based on the amount which the holding company charges, but it's actually based on the fair value of the options or the awards of the holding company. So that's a kind of important item to remember. There could be a difference between what the parent holding company may actually charge versus what the fair value would be, and therefore that's an equity transaction. In the holding company's book, it would do a receivable from subsidiary debit. It would create a share option reserve, because ultimately is the holding company's shares, and once it is the shares are exercised, it would debit the share option reserve, credit share capital. And there'll be another entry when the cash comes in, it will get cash, it will debit the receivable. So I think that's the kind of scheme of entries, in the holding company and subsidiaries. Let's move to the right side, where holding company decides not to cross charge. I'll again start from the bottom. In the books of subsidiary, it's the same. Entry number one, debit employee share-based expense, credit share option reserve. Now there's no charge, so the second entry which we saw earlier will not be there. In the books of the holding company, earlier you saw, the holding company would have said receivable from subsidiary debit, but now it's not charging the subsidiary. So instead of debiting receivable, it is going to basically say, look, it's more like me investing more amounts in the subsidiary, me basically capitalizing the subsidiary. And so instead of debiting a receivable because there is no receivable, I will debit the investment in subsidiary, credit the same share option reserve, and then once the share options are exercised, I would debit the share option reserve and credit equity share capital. So I guess this is again not uncommon. Many subsidiaries of MNCs and others, you would see it. So look at it from that perspective. The important element is there a cross charge from the holding company or not? And depending on that, the accounting entries could be slightly different. I'll move forward, and that's the next one on segments. Now, again, an important area, in terms of segments, what do you disclose and how do you disclose it? What I've tried to look at is one example where company kind of does an restructuring, and there's a lot happening now, especially after during the last year we are seeing restructurings which have been taking place. So the example here is segments as at March 31, 2021 is A and B. There's an internal reorganization which takes place on April 30, 2021. Now the question is, as the financial statements are getting authorized and issued, should the new segment structure be presented in the financials? Now, really the answer is no. The new segment structure should not be presented until it is really, reviewed and managed on the basis. And as of March 31, 2021, the business, the results, the operations were not reviewed on the basis of new segments. So, this is like a subsequent event. It should not change the way segments are reported up to March 31, 2021. Of course, going forward, the next quarter or next half year as it is, it will be changed, and then you'll also change the comparatives for the previous years. But at least for March 31, 2021, since the CODM was reviewing the results in the old fashion as segment A and B, it would not get changed. The other thing which I would like to point out, which is not on the slide, that whenever there are changes in segments, one more area one should look at is goodwill, because many times goodwill is monitored by management at the segment level. It cannot obviously be above segment level. That's not permissible. So when goodwill is managed at segment level and there are restructuring which take place, then that means based on changes in segments, the goodwill also may need to be reallocated to revised segments. Now, one is that which you'll have to reallocate it, but the more important aspect is that based on the reallocation, when you do impairment analysis, one would have to look at it carefully. That basis that now, the the carrying value of the CGU of that segment now, with the revised reallocated goodwill balances, does that result in, any impairment? So I think a point to note, one is, when do you change segments? A little bit like the restructuring one, the timing is important. And secondly, when you do change segments, there could be impact on goodwill. This one is a quick one. Entity has a single reportable segment. Is the entity required to give disclosures under Ind AS 108? The answer is yes. There are some minimum disclosures. This has also been the comment of, during the FRB review. So of course, there are these various items which need to be disclosed, even though the company has only one segment. You need to disclose the revenue from external customers broken up by products, services, etc. Domicile of, the country, if there's international, geographical kind of split of non-current assets. And the most important one also is, the reliance on major customers, specifically if there's anything exceeding 10% from a single customer. So the answer is, just because you have one segment doesn't mean that Ind AS 108 doesn't apply. There are other entity-wide disclosures like these mentioned here which needs to be given. So please keep that in mind. I'll move forward. Ind AS 1, in terms of presentation of financial statements. Again, this is a pretty interesting topic, I would say. It's about reverse factoring, and I'll spend a few minutes on this. Now, typically, we all know about factoring of receivables, where you sold a good to a customer. The customer would, of course, maybe go and discount it and get its money. Sorry, your supplier would then take that receivable, discount it with the bank, get your money ahead of time, improve your working capital. Right? Now, this is reverse factoring, where really what happens is, there's an entity procures goods from a supplier, is got to pay the supplier, let's say, at the end of 30 days. But what it really does, it gets a bank or a financial institution to pay the supplier at the end of 30 days. But instead of that, what it tells is, look, the bank will then pay the supplier at the end of 30 days, but the company which has procured the goods will enter into an arrangement with the bank that instead of me having to pay the supplier at the end of 30 days, the bank would have paid it. Now, you give me some extended period of time to pay the bank back, let's say 90 days or some additional period. What's really happening is that, a relationship from a trade payable, which was amounts which is payable to a supplier because of procuring goods. Now, the entity which has procured the goods has involved a financial institution. It has got the financial institution to pay the supplier. So now supplier is done, is out of the picture. And now me, as an entity which has procured goods, instead of having to pay the supplier, I would have paid the bank. The question really is that my liability obviously remains, but my liability to supplier has been substituted in a way by way of a liability to the bank. So in terms of liability, it's fine. It still remains in the books. Instead of something which I would have paid 30 days, now I'm going to pay, let's say, at the end of 90 days. But the question really is that now, should that be called a trade payable? Because trade payable, is part of typically the working capital, or should this be called a borrowing? And of course, when you start calling it borrowing, it has other implications, right? It has, your debt coverage, your leverage, it impacts EBITDA, etc., etc. So not EBITDA, but it impacts your interest cost and other aspects. So, companies have maybe in the past taken a different view, even though, the initial liability was to a supplier. But because it has been now substituted in a way to the bank, the more appropriate answer should be that it should be now called out as a borrowing. And this has been an area of, I would say, debate, discussion. And again, there has been IFRIC agenda decision on this. And having said that, based on the facts and circumstances, this would be considered, a borrowing, right? And the reason is why borrowing. One is because trade payable is something which is in your normal working capital. Now, if you have agreed for an extended period, that means obviously that's not necessarily a normal working capital. It is obviously benefiting the company, not the supplier, because supplier has got his or her money on time. It's the company which has procured goods who's getting a longer period to pay. And there's interest cost, which now the company will have to pay to the bank or the financing institution. So keeping all that in mind, one would say that though this originated in the form of trade payable, but subsequently, because of the changes and the way it has been dealt with, it would then need to be reclassified as a borrowing. Important area, be mindful, take a look at it, if there are the clients or others, who may have such arrangements. I'll move forward, on presentation again. This is really around, when you recognize expenses in 1 year in a period, and the later, there is, let's say, write back of that, liability because the liability is no longer payable. So, in the subsequent year, do you really show that as a reduction of that year's expense or another income? Again, I think there are different views on this. Some think that it should be a reduction of expense in the subsequent year. Some believe it should be income. The logic of it being a reduction of expenses that look, this is really a change in estimate. Liability is not payable. It doesn't really meet the definition of an income, so it's best suited to be like a reduction of expense. There's some analogy for this in the inventory standard, Ind AS 2, where when you have a write down of inventory provision in 1 year, and the subsequent period, if it is reversed, the Ind AS 2 say that should be shown as a reduction of that expense. So drawing an analogy, one view would be that in the subsequent period, when the liability is reversed, it should be shown as a credit in the same line item in which the original expense was recognized. Again, and not another income. But again, I think there is diversity in practice. At least this is my view, from an accounting, from a presentation perspective. I'll move forward. This is really I've picked it up from the expert advisory committee opinion. And this is, really, I'm quite sure many of you may have looked at it. But what I want to really focus on is that this is where a company, is to receive subsidy from government. But that whole approval process for getting a subsidy took 4 or 5 years. And straight at the end of, 5th year, the company got subsidy for all the past 4 or 5 years, right? That's pretty much the fact pattern here on the screen. The question is, should this be an exceptional item as income, exceptional income, because it is, material, it relates to last 4 or 5 years, or it should be part of your regular income, right? The ESC opinion is that this would not meet the definition of exceptional item. And the way ESC is looked at it is that this doesn't meet the test of, for something to be exceptional, it's going to have, 2 tests. One is test of materiality, size and nature. And of course, this is material. Clearly, it's like last, I think, 15, 16 to 20. So almost, 4 years of subsidy getting recognized in 1 year. So it's surely material. But I guess the ESC said this doesn't meet the test of incidence, i.e., this will reoccur. The subsidy income will come again because it is for the next 15 years. It so happened that for the past 4 years, it all got accounted now in 1 year. But again, next year, then year after next, and so forth, there will be subsidy income. And therefore, it doesn't meet the test of incidence because it will reoccur. And therefore, it should not be an exceptional item. Yeah. So I think important concept, that thing to keep in mind, that it should meet both the test of incidence, whether reoccurring or not, and materiality, which is size and nature. This one is a interesting one where again it's based on the ESC opinion, but I thought I'll cover it, which is presentation of mark-to-market losses or gains on derivative contracts, which are kind of taken to in response to foreign currency borrowings. Now the real point here is you do have outstanding foreign currency borrowings. Of course, in those borrowings there'll be interest cost, and you have taken derivative to hedge that foreign currency borrowings. But the company is not applying hedge accounting under 109. It is recognizing those derivatives as fair value through P&L. So the question really is, how do you present the mark-to-market losses or gains on the derivatives? And again, the ESC response was that, look, though it is not hedge accounting is not done, but of course, in reality, this would probably be an economic hedge, clearly, and therefore, in absence of very specific guidance on where this needs to be presented, it would be appropriate to show this mark-to-market losses in relation to derivatives taken for hedging these borrowings, as part of overall finance cost, but as a separate line item, seeing other borrowing costs within the finance cost note, and of course giving the disclosures of both the interest on the borrowings and the mark-to-market losses on the derivative contracts. And of course, finally, the accounting policy on presenting these should be appropriately disclosed so that it can be consistently applied year after year. I'll move quickly. Last, I think, few slides from my side on related party disclosures now. And the question, this has always been, do an entity's key management personnel include non-executive directors? And at least in the Ind AS, the answer is yes, because the definition is very clear. It says key management personnel includes any director, whether executive or otherwise. So, it's there in the standard. So, non-executive directors, supervisory board members, basically they kind of come to a conclusion that they have a responsibility for, management of the business, supervision. And so therefore they would be considered as key management personnel. So both non-executive and executive would be considered from an Ind AS 24 perspective. I think this is my last slide, and this is on, I thought I'll just pick up some key FRRB comments which came up. The first one on Ind AS 101, I think one of the comments which was there was, look, the reconciliation between previous GAAP and Ind AS could have been better. It didn't show the items to understand, the impact of the reconciliation items on the balance sheet. So I think that's something to take away. On kind of borrowing costs, again, interest was capitalized up to the date of asset put to use, whereas the Ind AS 23 would say it's not date of put to use, but date when the asset is ready for intended use. We discussed that just previously. The comment on Ind AS 37 was, expense for VRS, a voluntary retirement scheme, was recognized as incurred. But like you would know, these termination benefits, would ideally be recognized at the earlier of, when the restructuring is recognized, or, when you have no option to kind of obviously withdraw from the offer, right? So at that point, you would recognize it. So the expense probably will have to be recognized earlier than what was written in this policy. So I think that was the other comment. The other one on Ind AS 1, loan from related party, it was the interest-free loan, repayable on demand, and this entity classified it as a non-current liability. Now, typically, I think this is again an interesting area. If you have to classify something as a non-current liability, then there has to be, a clear ability to avoid, repaying that loan within a period of 1 year, right? Now, in a related party transaction, if it's something which is repayable on demand, it may well be that the parent doesn't demand, but you need to have a contractual right to be able to defer it. If you don't have it, then you would not be able to classify it as a non-current liability. So that's the kind of observation. And if I look at this, the holding company or the parent who has given the loan, it may actually end up classifying as non-current because it doesn't expect to receive it, right? But the subsidiary which has taken the loan, it has to have a contractual right or ability to defer repayment of the loan for at least more than 1 year. So I think there's a slight difference how you would treat a non-current asset classification versus a non-current liability classification. And the last point, and it's 8 p.m. sharp, corporate guarantees issued by holding company regarding a loan taken by subsidiary. There was no disclosure which was made in the financials. So I think it's a pretty straightforward point. One would need to always look at it and disclose it. So that's all from me. It's 8:01. I'm happy to take any questions. Let me try and get to the chat. I don't know if questions and answers, but
Mishra ji,
yeah.
Mishra ji.
हाँ मैडम क्वेश्चन दे रहा हूँ.
So Sumit, it was a wonderful session, excellent with a lot of clarity on every issue that you covered. I'm sure all the members have really benefited. Now we'll just see what questions are there. I'm sure there'll be a lot of things to answer also.
Yeah. Is there a way for me to see the questions in the chat?
They'll put up on the screen the questions.
Okay.
So you'll be able to see the screen. Yes, there they are.
So let me start with the question one. The company got leasehold rights from government of India for land 30 years, which is when you renew the company get consideration to acquire rights. The rights is transferable in nature, where the company can adopt a revalued model for such land for transferable rights. Additionally, annual lease payments and service charges paid to government as an ROU. So you have a right of use asset and it needs to be revalued. I think I would like to think about this actually. I don't know, Sandeep, if you have an immediate answer on this, on an ROU asset, which is issued from government, would you be able to revalue it? Maybe we'll come back to that. I'll move to the next one. CSR expense is a day one obligation. Then whether it should be recognized in quarter one or should it be apportioned in 4 quarters? So look, this is a question which is quite debatable. Now, I will lay it out as to what the scenarios are. Clearly, as I've understood, the CSR expenses, if you have profits for the last 3 years, then you would need to, you'll be liable to pay CSR, in the 4th year beginning. We also understand that, on day one, that amount comes up, though you've been given a year to spend it, but that obligation does come up, on day one. And I think even from a legal perspective, it looks like the company has to be wound up. It may have to be, still paid. So that there is a ongoing discussion on that. I would leave it at that until this is more clear. But yeah, it's an interesting question which needs to be resolved. I think the other aspect which some
Absolutely,
people
Sumit,
are trying,
because
yeah, I
absolute
think other,
Sumit, this is CSR is an absolutely valid question, because with the amendment
yeah,
now becoming effective February, whether it will
yeah,
be liability for March 21 or not, very interesting question.
yeah, yeah, and I mean there's a concept of, and I think I spoke about it in Ind AS 34, in interim accounts. Can you defer it? Can you not defer it, right? And like I said, recognition of assets, liabilities have to be consistent, like in annual accounts. So I think the long story short is that the alternative view which is coming up is, because you've been given the 1 year to spend it, therefore can we defer over a year? That's the alternate. But you know what? I think, let us wait for some time, and hopefully we will have an answer on this. Okay, company taking TL after 2 years. Company taking term loan for qualified asset after 2 years when asset ready to use. From third year, loan becomes NPA. Which are interest for 2 years will be capitalized. So, I mean, I think I will try and give a more principal answer. Look, if you have a loan, if you are recognizing interest expense on that loan, and during that period, if there is a qualifying expenditure, then you ought to capitalize that interest. So I think the first step is to determine whether you have a borrowing, whether the interest is being appropriately calculated on the borrowing using an effective interest rate method. And once that is being done, then that borrowing cost, shall get capitalized if you have a qualifying expenditure which is being incurred. So I'm not sure whether the NPA or non-NPA makes necessarily have an impact for a borrower unless it has actually been modified. So I think I would go with, is the interest recognized? If yes, is there a borrowing? If yes, is there an ongoing qualifying construction expenditure? And yes, then you got to capitalize it. Okay. As a finance head of an ITS company, I totally resonate with AS 23. Perpetual discussions with the MD on this. Okay. I'm not sure. AS 23, you mean borrowing cost? Okay, fine. I'm happy that you resonate. That's good. Whether the borrowing cost related to capital WIP will be classified as investing activity in cash flow or financing activity in cash flow statement. My understanding is that it should be actually classified as investing activity. I think that's where I think it would be, and then it would need to be separately disclosed as interest expense as a cash flow item. I'll move down. If specific borrowing is used for other acquisition of qualifying assets, it might be non-compliance of contractual obligation with lender bank. Would this still be considered for capitalization? Also, now there is specific reporting on CARO 2020, how to deal with this if capitalization of borrowing costs allowed. I don't think there should be a challenge with I mean bank borrowing, etc. There was a term loan, you used it for purposes of constructing another asset earlier. Now that asset is complete, but your borrowing is still outstanding. That doesn't mean you've diverted that money for something else. It just means that you have a borrowing outstanding, and now based on the standard, it says the incremental cost concept. And it says because you have a borrowing outstanding and you have capital expenditure, even though technically it is not 1:1 linkage, but conceptually that's what the standard has said that you should do it. So I don't see that as a challenge, frankly. Uh, I'm going to come down. Question 7. If there is a past service cost going to arise in the next financial year, increase and gradually benefit, whether provision for past service component can be made current financial year under Ind AS 37. I think the answer to that should be under Ind AS 19. I think there's a bigger question on that, which is yet to be closed. Just like you have the question on CSR. I mean, I have a personal view on that, but this is not. I think we've got to still get an answer to that more broadly. But coming back to this one, the question is again on gratuity because of the amendment in the security code, social security code. First, it needs to be determined what's the effective date, and it needs to be notified so we are clear how to deal with it. Let's say we become clear about that. I think it needs to be understood whether this will be treated like a past service cost as someone in the audience has mentioned. If it is a past service cost, then it would be when that is implemented, when that is affected, and therefore it will depend in that period, when the amendment happens. If it's a past service cost, if it is a actuarial gain loss, then there could be a different answer. Therefore, do you consider, subsequent event and consider it? So I think there is not going to be an answer on this right now. We have to wait for the rules to come in. We have to first get to an answer whether it's a past service cost or actuarial loss. That's one. And depending on that, when the rule is implemented and finalized, it would be then looked at whether it should be considered in March 2021 or not. So I'm sorry, I can't give you an answer on that right now.
Sumit, we have Ashutosh who will cover this at 19. Rightfully, you mentioned that it moves from 37 to 19. So I think Sumit, Ashutosh is covering this tomorrow.
Yeah. Okay, superb. I'll go to the next one. Please, I can't see can you just scroll down, please? Can we scroll down? Because there's a lot of discussion, Sandeep, on this matter, on past service cost, within the professional community, with the actuaries, with preparers. I think there are there are two very important views. So, I don't want to kind of, get ahead of that and respond to that right now, just like the one on CSR, Okay. In case of damage due to fire, condition was existing on March, the event came in. No, it's not an adjusting event because the virtual certainty has to be achieved at the balance sheet date. So it would not be a subsequent event. If subsequently it's communicated, that's a non-adjusting event. I know intuitively it doesn't sound, kind of one would expect that, look, you submitted the claim, before 31st March, fire happened before 31st March, then can you not say it's a subsequent adjusting event? But the reality is you've got to see whether it was virtually certain as of 31st March, and it was not. And until the insurance company accepts it, communicates, it's not. So it could best be a type 2 disclosure in the financial statements. I'll move forward, and again, this is a very, it's discussed so many times. So I can understand whoever is asking that question. I get that all the time. Let's come down. Question 9: is the accounting for ESOP expense in the US GAAP straight line versus Ind AS, which is graded vesting? This seems a gap difference. When will this get resolved? US GAAP has an option, straight line or accelerated. Like Indian GAAP, previous Indian GAAP. Ind AS does not have, IFRS does not have. When will this get resolved? I don't think I have an answer to that, unfortunately. This is beyond me. Okay. I'll move forward. Should independent directors be included in KMPs? The answer is yes. Under Ind AS, they should be. And that's what was my point in my previous slide. Because the definition says executive and non-executive. Okay, is there anything else? Any other questions?
No, I think that's it.
Yeah. Sorry?
The aggregation
That's
is.
it, I think. बस इतना ही है ना question? Okay. Okay.
Yeah,
Thank
so
you
I
so
think,
much. So now-
Christy, one question I would like to look into, which is that land, on government and whether it can be
The first
revalued. Yeah, I think that's a question I would want to just
Mishra ji,
apply some
वो
thought.
वापस रखो वो questions.
I don't know, Sandeep, if you have a view on that. Otherwise, we can come back to people on
No,
that.
we come back because I couldn't get, because when he's saying it's an SEZ land and so probably we'll need one additional fact, because I think it's
First question.
Yeah. Actually, I've not thought through this, whether ROU assets, you can do revaluation in land. I need to think about it. So it's a very good question. Maybe we should pick it up later. Yeah.
So
Okay.
I think if we can have the member who's asked this question in the chat box, maybe if we need to get some facts, Drushti. I think the objective of this webinars are to even address questions and not leave it open-ended. So if we have it, I think we should be able to certainly.
Yes. We will have the details. Yes, we will have the details of the member who's put up the question.
Yeah,
so
that's a
we
good
can definitely get some more elaboration on the same. So thank you so much for this wonderful session that we had. So thank you, Sandeep Bhai, also for your support all through. And now may I request Monarch, who's there with us, to propose a formal vote of thanks. Monarch, over to you.
Thank you, ma'am. So it was a wonderful session, sir, and thank you so much for delivering insights on various areas, and also what necessary factors to consider while applying this crucial areas with your practical case studies. I'm sure participants today have gained a lot of knowledge and learning from your today's sessions. On behalf of WRC team, I would like to thank you once again for your valuable time every time when it is needed for the benefit of our community. Thank you so much, sir.
So thank you very much. Thank you for having me there.
Thank you very much for being here.
I really liked the questions which came in. They were pretty good.
Thank you so much.
Yeah.
So we meet again tomorrow, everyone, same time. And again, we'll have next 2 sessions of Ind AS, all the issues related to the other Ind ASs, which will be addressed by the experts on tomorrow's panel. And day after tomorrow, we have I think as the chairman had elaborated in the beginning, that we have a session on the amendments to finance bill, which will be taken up by Gautam Doshi sir, and he will elaborate and explain the amendments to the finance bill, which has now been enacted. So have a very good evening, all of you, and we call it a day now. Thank you so much.
Thank you.
Bye-bye.
Bye.
Thank you.
Bye.